My name is Keshav Reddy. I'm a consultant at NSR Cell. It is very good to see such a large audience on a Saturday early in the morning. I know that actually you guys are looking forward for the Nitin's talk, then Anirban's talk. I'm in between, I know that. How many of you are founders? Oh, that's very good. Okay. How many of you are planning to start your startup in next 3 months to 6 months? Good. So let me just give you the quick intro of NSR Cell, then actually I'll not take more than 2 minutes. This is the impact. I'm pretty sure all of you actually, when you walk through the NSR Cell, you might have seen this actually. So we have touched upon 50,000 plus entrepreneurs, 240 plus companies incubated. Quickly, those of you who's planning to start in next 3 months or just started, this is a program actually you should apply, okay, which is a Launchpad program. Please look into that. Okay, mostly when you're starting or just started, there is lot of questions, I'm sure. Okay, so those questions will be very much addressed in the Launchpad program. Next, we have a incubation. Okay, so those guys who are looking for getting incubated, please write to us. ideas@nsrcell.org. You can also apply. So these are the other programs we are coming up with. How many of you are planning to work or working in fintech space? Okay, so we have a fintech program coming up. Please watch out. So we will get back to you. There's a fintech accelerated program, okay, and a mobility program also we are coming up. These are our partners. So that's our email ID, ideas@nsrcell.org. With that note, actually, I will not take much time. Let me, how many of you heard about Zerodha? Good. Okay, fantastic. So let me invite co-founder and CEO of Zerodha, Nitin Kamath.
This whole talk is about funding for startups, and I'm probably the wrong person for it because that's one thing I haven't done as a business yet. So we got lucky, being able to bootstrap through till here. So what I thought I could do is maybe I can talk about a little bit about my journey, and then maybe if there's some learnings for you guys, or if you want to ask me what kind of helped me kind of get through till here by bootstrapping, and I'd be very happy to answer. So I think it's better to keep this Q&A than me just talking about something which I don't know about, right? So so I just to give you a brief background, I'm born, brought up in South Bangalore, so I've been coming to the Rock Show at IIMB from the time I think I was 16 years old. So every time someone invites me to come talk at IIMB, I can't say no to it, because every time I used to come for the Rock Show, I used to think, maybe one day I get to go attend this college. And I did extremely bad at my school and college, so I never got through to anything like a real MBA school. So thanks for having me here, NSRCL. So I didn't really know the audience is going to be this big. And I don't really have a presentation, so I'll just run you through my life. I started trading very early. I started trading when I was 16, 17. Now, why trading? Lure of quick money, because I used to live in a neighborhood of Marwadi. I used to stay in Vivipuram. I don't know if any of you are around from Vivipuram. There's a lot of Marwadis around there. And so there used to be this whole Marwadi community who used to trade the markets. I got introduced to trading the markets when I was 16 or 17. Then once I started trading, I started doing, I was already quite bad at school. I became even worse at it. I did go to an engineering college, and then I think around 2001, 2002, I had kind of stacked up decent amount of capital trading the markets, but then I blew it all maybe in 2 days. I don't know, in 2001, I don't know how many of you trade futures and options here. Futures and options got introduced to the Indian markets. NSE, the National Stock Exchange, introduced it. I thought it's a great product, and markets were going down. I thought, it's a good time to buy, and it just went down lower, and then I kind of lost everything in 2 days. So I went back, joined a call center. I worked in a company called Dial-M, which was part of the Manipal group. I worked in a call center for 3.5 years. Why call center? Firstly, it was quite cool back then to be working in a call center. And secondly, with the call center, you could work nights, and so I used to get time during the day to trade the markets. So I did this from 2001 to 2004, 5. And so one day, I was working out in the gym. The guy next to me on the treadmill asked me, Nitin, what do you do for a living? And I said, I trade the markets. I used to trade with ICICI Direct back then. So we caught up for a drink, and I showed him my trading account performance, and he said, dude, you seem to be doing quite well trading. Why don't you do this for me? Right? So he cut me a check, and I quit my job, and I started my portfolio advisory business. So I used to manage people's money. Not in the legal sense, because there were no licensing back then. Today you need to be a portfolio manager and all of that, right? So back then it was just an arrangement with him where I had a deal saying that I'll make 20% of whatever profits I generate for him. Slowly, I started making money for him, so more people, he introduced to more people, so the 1% became 100 people for whom I used to manage money. Now, as soon as it became 100 people, there was another problem. The problem was, how do you actually place trades for all of these people, right? The way to place trade was, I used to log into his account, place an order, log out, log into another person's account, place a trade, and it was a crude way of doing it. At that point of time, Reliance Capital launched their broking arm called Reliance Securities. Now, so I became a sub-broker for them. A sub-broker is a franchisee. So, as a sub-broker, you get his brand, and you introduce clients to him. I set up an office just down this road. If you've seen the Vodafone store, just above that. I set up the store. I set up the office. I took a license, sub-broking license. Now, with the sub-broking license, you got what is called as a dealer terminal. It's a terminal where all your customers are mapped to it. So instead of now having to log in separately and place trades for separate people, you could kind of have all your orders as an Excel sheet, and you can bulk upload it, right? So I became a sub-broker more for it. But as soon as I became sub-broker, I started interacting with Reliance Securities more and more. So I started getting to know what actually happens behind the scene, because until then I was a trader, so I used to just look at the front end. But then as soon as I became a franchisee, I started talking to people behind the scene. I figured out that, what happens behind the scene. And Bangalore is not really the ideal place to be doing broking, right? As in, even today, a lot of people assume that we are based out of Bombay and etc. Right? So that happened in 2006, and in 2008, markets fell. For all of you who trade the markets, you can make money in a falling market. So we were short on the market, so made a little bit of money in 2008, right? So in 2009, there was a small little incident that happened. I don't know how many of you track this, but the biggest two-day move in Indian stock market history is May 2009, when election results came, right? So no one was expecting election to be favorable for any party, and then you suddenly had UPA winning it by big margin. So stock, the index went up 20% so the market opened and the index was up 20%. Now, one of the ways I used to trade the markets was trading volatility and not direction. I don't want to get into that, but generally the idea was you make money when markets move either up or down, but by a certain margin, and you're not really calling the direction. It's more like trying to take a bet on will Virat Kohli make 50 to 100 in the next match, or is he going to make more than 75 in the next match, right? So the odds of winning is a little higher when you're calling a range, right, and calling the volatility. So one of the, in hindsight, I think the best thing that happened to me in my life. But on that day, it was quite painful. I was long volatility, so the day before the election. So that means any big move would have made a lot of money for me. Now, at 325, markets closed at 330. I exited all my positions. I don't know why. And next day morning, a potential trade that could have been up, 5x, 6x of the capital was not up. So, right, and market shut down, and there was a lot of frustration built. So there is a resort down this road called Eagle Ridge. Market was shut anyway. So we were 4 of us working in our office. So we shut down the office, went there, got drunk, and then in that whole state, I was like, dude, I want to take a break from trading, So, and by then, my younger brother had joined me for trading, and you can call it evolution or whatever, but he's a much smarter trader than I ever was. And so I was like, if he's anyways a better trader, why do you need 2 people trading? Let him continue trading, and let me probably give a shot at being a broker, right? So that first idea came in 2009, May 2009. And one of the enablers for the idea was National Stock Exchange of India had launched this product called NSE Now, right? So today, if any of you have traded the markets, right? For a broker, the biggest cost is actually the cost of running the trading platform, right? As in, you need that platform, the technology cost. Firstly, it's the cost. Secondly, you need to have the right kind of people to build the platform, right? You don't really find too many people who understand trading, firstly. People who understand trading plus technology, right? And then trading plus technology is that kind of power the capital market ecosystem. It's very tough to find that kind of crowd, right? So yeah, but the good thing was NSE had launched this platform called NSE Now, where they were giving a trading platform free of cost for the brokers, right? If you become a member of the exchange, they give the platform free of cost. And so the opportunity I spotted was that here is technology that's coming free of cost, right? As in trading platforms coming free of cost. So is there an opportunity to kind of go disrupt on the pricing, right? Because if trading is free, the platform is free, what really is the cost, right? Is your operation cost. And through my life trading with, I had traded with 12 different brokers before Zerodha. And through my life trading with all these brokers, interacting with people, I realized that those people working in this company are really not adding any value, right? Value for people like me, right? People like me who are active futures and options traders, who track the markets, who don't need relationship managers. I don't need advisory. I don't need research. I don't need anything, right? If I don't need anything, why should I pay for the cost, right? If I'm never going to walk into someone's office, why do I need to cover for someone's fancy BKC office, right? So the deal was, can you be in Banagatta Road in a 800 square feet office and be able to power at extremely low cost and kind of disrupt on the pricing. And so and what we tried to do with Zerodha when we started wasn't like anything new. US had done it from the 80s and early 90s, right? Discount broking was something that E-Trade, Charles Schwab, and all of them had tried and made it work for a long time, which was a flat fee per trade, right? In the business of trading, the cost of executing a trade doesn't go up with the size of the trade. So what it means is if you place an order to buy, say, 1,000 rupees of shares, or if you place an order to buy 1 million rupees worth of shares, I as a broker am not incrementally putting any extra effort, right? You as a customer has actually put more effort to bring in more money on the table, right? That means you have actually put $1 million in, and that's why you're placing an order for $1 million, right? So the pricing model problem in India was why should the brokerage go up? Because every single broker was charging a percentage fee. So it's almost like saying, if I buy more idlis, I have to pay more for the idlis. It's like that, right? So we said it has to be a flat fee per trade. It makes a lot of sense, especially in a tech-enabled world. So we decided to charge 20 rupees per trade. Now, why 20 rupees per trade? It sounded a lot more cleaner. We didn't want to end up, sounding like a 19.5, sounding like you're trying to compromise and, kind of set that kind of a brand image. Also, the biggest traded contract back in 2010 was the Nifty futures, right? Here's an interesting thing. I don't know how many of you know this. In the stock markets, 0.5% of business is actually from equity delivery trades, right? What's equity delivery trades? Is people who buy stock, hold it overnight, and sell it, right? Which is what 99% of the people think is stock markets, right? So that's actually 0.5% of the business, right? 90% of the Indian stock market turnover comes from derivative trading, right? Futures and options trading. 9.5% comes from equity intraday trades, people who buy and sell stocks during the day, right? So the remaining 0.5% is all that comes from, people who actually invest and wait for it to go up, look at fundamentals and all of that, right? But so when we started the business, our business was not really wired for investors, right? We were trying to build a business for futures and options traders like us, right? Like, people like me, who are paying a lot of cost to brokers, we thought, we can save it for them, So we started the business in 2010, and more than the flat fee per trade, I think so I come with no tech background, okay? As in, the only tech I've probably done till now is Excel sheets, So when we started the business, there was, we started with, I think around 1 crore and 70-80 lakhs. So 1.5 crore is what costs, is the deposit you have to pay to the exchanges for membership. And so we were left with 20, 30 lakh rupees, to start the business. So I spent, I think, 70,000 rupees on doing our website. And the most disruptive thing we did when we started in that website was we put out something called as a brokerage calculator, right? So now you enter your trades, it tells you what's your upfront cost before you take a trade, right? Now, why was this disruptive? Because financial services firms around the world make money by being opaque, right? They don't make money by being transparent, right? So, so until then, through my life, when I was trading with all these brokers, if I was to ask, can you tell me what's the cost? They're like, no, why don't you figure, why don't you look at the contract note, and all of that, right? No one used to actually upfront come and say, this is actually the cost. Yeah, so looking back at it, it's probably the simplest thing that we have done as a business, but it was back then the most disruptive thing, because there was this one broker who suddenly came and said, I will tell you all the costs up front before you actually take a trade, right? The other thing that helped when we started was I was a very active pseudo self of mine in a lot of online communities, right? So I used to, through my, by the time Zerodha started, I had already traded for 12 years. And so I had the biggest Yahoo Messenger community in India. I had the biggest Orkut communities. In all my pseudonyms, I won't tell my pseudonym because some of them are still running. So, so through my life, I've been trying to kind of share knowledge and all of that jazz. So so it was easy to kind of build a community. Even today, I spend 2-3 hours every day actually answering people's queries and etc. Right? So there is that kind of brand that you build by being that. And that's not like something that is, I'm doing for the business. I've done it 12 years before business as well. So when we started the business, the first few thousand customers were through those communities, So these communities were, where we started talking about it, and people, respected this person who was talking about it. So they believed that, I should maybe go try this relationship with this company called Zerodha, right? And because in the business of money, credibility is the most important thing, right? As in, people don't trust you so easily, and especially when you're low cost, right? I mean, as soon as you say, you're extremely low cost compared to the rest, you're like, next question is, dude, what's the catch? Like, think of it, right? As in, if someone said, you will get 12% for your fixed deposit at Amanat Cooperative Bank, would you actually keep money there, right? Because as soon as someone said 12%, you're like, dude, dude, is my money safe, right? So now, because with us as a broker as well, people actually keep their hard-earned savings, keep their stocks, securities, life savings, etc. with us, right? So, so you have to build a brand, that people trust on, right? So, so the biggest challenge, I think, even today, when I talk to a lot of startups, is that you haven't seen so many fintech startups around savings and investing, is because people are not able to survive and long enough to actually build that trust, right? As in, so yeah, so anyway, so we started in 2010. We did, this community work. Back in my call center days, I used to love telecalling. So, the first 1.5 years of the business was all, cold calls and, this online communities and etc. I think the first 5,000 customers, I must have met 4,000 of them. And I used to meet them calling myself as Sachin, because you didn't want a CEO of the company going meeting people, collecting account opening forms. So we've done every hustle possible to kind of get the business running. In 2011, September, Economic Times wrote a small little article on discount broking, right? And they quoted us somewhere there saying, there's this company called Zerodha who's doing this in Bangalore, and this is how flat fee pricing model works, and and then that was the first time kind of credibility came through for our business, right? As in, people actually suddenly said, probably the paper is saying it, it's probably real, So like, it's so funny that, like my dad, I keep talking about it. My dad watches this Kannada news channels, and he keeps telling me, dude, this news channel said there's a ghost in this house, and he kind of believes it, So like, the thing is, when press says it, right, there's so much more credibility. I kind of realized it only once we got our first feature going. The funny thing here is the person who wrote, the journalist who wrote, he had called our office and actually spoken to him as Sachin. And then he said, can you put me on to CEO? And then I actually changed my voice and I said, oh yeah, I'm Nitin. So, yeah, so 2011 is when this happened. And so the other things that we did along the way, in 2011, we also put out a blog post. I started blogging about everything about business and markets and etc. And people had never seen that as well, right? As in, you would never seen a bank CEO or broking CEO actually coming, putting his head on the table, right? Because, you know, these are blogs which are very active. I think we probably run the most active blog. Like, you know, like there are blog posts with thousands of comments on it, right? And not really moderated and all of that. You know, unless someone really, you know, tries to use profanity, etc. We never moderate, you know, any content. So yeah, so we started blogging, and around 2013, the first competitor came around the scene, and who was telling exactly the same story that we were trying to say, which is, I'm low cost, I'm transparent, I blog, you know, we're a nice bunch of young guys, etc. And then that's when it hit on me that, dude, you can't really build a business with no edge, right? As in, if anything that can be copied so easily, someone's going to copy it, right? And then the challenge was, like, you know, that you knew that you had to build a better product, right? But then the challenge was to find the right kind of people to help you build a better product. Right? Today we are called a fintech company, but back then we were called a broking company, right? Because brokers, you know, stock markets, gambling, I mean, these are all not looked in great, you know, like in this country, right? As in, through my life, I keep saying about this, through my life, people have told me to go get a real job, you know, so, right? Because whenever I was trading the markets, right? Because especially in South India, especially, you know, like a South Indian Brahmin boy, you know, like, you know, trading the market isn't like a cool thing to do, you know. So, so yeah, so in 2013, I got extremely lucky to find Kailash, who heads our technology today, right? I mean, he heads our technology right from then. So he was doing a startup, you know, and I was trying to bankroll the startup. And the startup didn't get regulatory approval, so they folded it. And then I somehow went and convinced him, saying, boss, there is a mother of all bull markets waiting to happen in this country. Can you come join us? And he got sold, and he came, joined us. And around him is where our product journey started. 2015 is when we put out our first in-house app, which is called Kite. Right? The approach was completely different to how traditional platforms have been built in India, which is we wanted it to be clutter-free. You know, usually the problem with, I think, with a lot of this Bombay crowd is they try to please 100% of your customers, right? They want to give all features possible, all, you know, it just ends up cluttering the entire platform. And especially when you knew that world is going mobile, you know, you want to replicate the same on a mobile, it gets even more complex, right? So, so yeah, so we took this whole minimalistic approach. You know, I still remember we went to exchanges for approval of platform, and they asked, why is it so white, right? So, like, you know, and because they hadn't seen, because traditionally platforms were dark in color, they had this flashy, you know, patches of red and green all the time. You know, it was almost like a video game, right? So we went and you know, put this platform out, which is clean and clutter-free, etc. And then they were like, so 2015 is when we launched this, and you know, people liked the platform. And what also happened in 2015 was we did probably one of the biggest growth hacks, as people call it today, which is we went zero brokerage on equity investing. Right? We used to charge 20 rupees per trade for everything. But what happened for the brand was, between 2010 and 15, was people started saying that if you're speculating, go to Zerodha. If you want to invest in stocks, go to ICICI or HDFC or whatever, right? As in, Zerodha is for, you know, speculating, not for investing, right? And we wanted to change that image, because by 2015, we also realized is that this audience that speculates in the market, people who generate revenue for us, I mean, you'll be surprised to know that there are probably just 300 to 500,000 Indians who actively trade futures or options on a daily basis. So it's a really tiny market, right? So can you really build scalable business just for like such a tiny audience? Maybe not, right? So we said we have to go after the bigger audience, which is your 6 to 7 million Indians who actually invest once a year in the capital markets, right? And maybe the 15 to 20 million Indians who invest in mutual funds once a year in the market, right? So that was the audience that we wanted to go after. And so it had to start from, you know, this whole image of the company changing from saying only for speculating to for everyone, right? So, so the incident goes like this. So me and Kay and our PR guy, we were going to Cochin. The flight got delayed. You know, we're having a beer, and I said, dude, you know, how about just going zero brokerage on equity investing? You know, it was just, and one of the biggest benefits of not having raised any funds till now is that we have the flexibility to take such kind of decisions without asking anyone, right? So it was a Friday evening, and Sunday morning we put out a blog post, and then this was December 2015 sometime, and then the last week of December, Economic Times had this mega feature of who are the people to watch out for in 2016, there was Mukesh Ambani for Jio, and next to him was Nitin Kamath for Zerodha. And I was like, dude, what the hell just happened, right? Because, and then, because that, this whole going zero, along with the credibility that came around with having all these articles around how this broker, because once Economic Times wrote it, everyone started writing about going zero, and I never thought it was such a big deal, right? Because as a business, we were making 2 to 3% of our revenues from equity investors, right? So it's not like we let go of a lot of revenue when we went zero, right? It was essentially like saying, it's not helping anyways, equity investors not coming, so why don't we just go zero? So yeah, so we got extremely lucky with that, that thing. Yeah, so then from 2015 onwards, the business started actually ticking up really fast. So you had a good platform on one side, you had, great pricing model, and then the virality started kicking in, right? And thankfully the market also started, kind of performing okay, right? And then, yeah, the next big incident after that as a business was Aadhaar and demonetization and all of that, right? Because until demon, people never really used Aadhaar. There was no real life use case for Aadhaar, right? And the biggest challenge for us as a business was just the onboarding, right? To open an account, you had to sign a 35, 40-page document, attach I don't know how many different proofs, we had to validate it, send people to go meet the person to do KYC. I mean, it was just ridiculous, right? As in, it was almost like, think of it, right? As in, you're trying to get into Ola, you're trying to install an Ola app, and they say, you can only use Ola after 15 days, right? As in, would any of this whole Ola business would have happened if you actually slowed entry into the business itself, by so much, right? So the biggest, I think, help for us in growing up fast was actually that whole Demon incident, because Demon incident meant that people started using Aadhaar. Aadhaar meant that, people started using it for e-sign, so which is the biggest use case for us, right? Which is people started signing a document using that, right? So, that happened, and then the business just took off, right? As in, we were opening 10,000 accounts a month, and Jan 2018 we opened almost like 80,000 accounts a month, right? So the first 6 years of 5.5 of a business, until 2015 December, we were at 70,000 accounts, right? So that means we added more customer in 1 month after demon than what we had added actually in 5.5 years, right? And during this journey, the other thing, which also helped was, so we started selling mutual funds, back in 2016. Now, the thing about mutual funds is there are two ways to sell. One is regular and one is direct, right? Now, back in 2016, the only way we could sell mutual funds was a regular mutual fund, right? In a regular mutual fund, when I sell it to you, the manufacturer pays me a certain commission for selling, right? Now, so you don't know how much the manufacturer is paying me as commission, right? So that whole business model didn't really go well, with the whole transparency thing that we were trying to say, right? So because one side I'm saying I'll tell you the exact cost and exact money you pay for using a platform, but on mutual fund side, I somehow will hide it from you, right? So we never really took that platform live, as in it was live, but we never sold it. In 2017, we also, 2017, I think May, June, whatever times, so we were able to offer direct mutual funds on our platform, right? So we started a platform called Coin, which today is India's largest direct mutual fund platform. So, and where we don't make any commission out of the customer. The other thing that we did, which has worked really well for us also, was that when we realized that we are kind of becoming a big fish in a small pond, we opened up APIs to every aspect of our business, and we started inviting startups to come build on top of us, right? Because what we realized, what we were solving for a business was, if someone has an intent to buy or sell stocks, we have a great platform. If someone has an intent to learn about stock markets, we run this initiative called Varsity, which is probably after Investopedia, the largest initiative around capital market education in the world, right? So we had stuff to cover for people with intent to learn. But then the audience, the percentage of the population which has intent to learn or intent to invest is maybe 1% of the entire population, that potentially can invest. So we said, how do you then grow the ecosystem, right? And then we said it has to be through niche, kind of unique experiences, right? A WhatsApp or something, something that gets people to invest. So we said, we don't want to solve for all the problems. We said, why don't we actually partner people to solve for these, right? And so today, the initiative is called Rainmatter. We don't not only give access to the APIs, we put in our own capital. So we allocated I think 50 crores for this. We have deployed around 20-25 crores on this. And this is our personal capital, so it comes with no raise money fast and grow fast and any of it. So we are essentially getting these startups to kind of follow what we did, which is get a great product up and then figure out the rest. So we've done that as a business, and today, last year we became the largest retail broker in the country, and like I just said, we're also the largest direct mutual fund platform in the country. We run the second largest, education initiative around capital markets around the world, and Rainmatter, we have the largest bunch, probably the coolest bunch of startups that are working in this whole savings and investment space in this country, right? So yeah, that's generally been the journey till now, and coming to the what has helped us the most. See, when we started the business, I was extremely raw. I don't think if I was a VC, I would have funded myself. In the sense there was no pedigree background, education background. There was nothing. I look at my presentation, the first one I had made for myself. It's a joke, I'm like, dude, how would anyone ever give me money for this, right? So, but the last 3 years, right? As we've done well as a business, the kind of checks people have been coming and offering us has been just ridiculous, right? As in, like sometimes I wonder, like, what's the math, So, but saying no to that has actually been, the strategy around saying no to it has been because the biggest edge we have as a business today is how nimble we are, right? As in, now I could be talking to one of you guys right now, take some input, go bounce it off our team, and Monday we could go announce it, right? I don't have to go take an approval of someone, I don't have to, right? I don't know if it's good or bad, right? As in, is it good that so much power rests in 2 or 3 people's hand, right? But should it actually go through a board because we are a big company and etc. But being nimble is actually our edge, right? And one of the reasons for not raising capital is because, one, we don't need it. We've been highly profitable, till now, and so unless I need to take money off the table, like a significant amount of money, it doesn't make sense to raise money. And I've realized personally that incrementally money makes no difference to you, right? As in, it seems like it does, but then I think after a certain point, it's just all the same, So taking money off the table also doesn't really make any sense. So we said, we need to stay this way, stay nimble. Like for example, would a VC allow me to use VC's money to invest in other startups, right? The biggest, I think the biggest thing that we have done for the ecosystem is this, this 12 startups that we have helped build, right? As in, because these startups today are solving for so many capital market ecosystem problems. I don't think that would have happened if I had ever raised someone else's money, because I would have never been allowed to use that for funding other startups, right? Now, for these startups, without the audience we gave them, I don't think they would have been able to kind of grow as fast as they did, right? Because as I said, the biggest challenge in this market space is people don't trust you, right? But when I put my head on the table and I say, I know this guy, this is almost like our platform, our customers trust this startup, right? And that's one of the reasons why some of these startups have been able to scale, right? Now, if you actually go back and see all the investment tech, saving tech kind of products, not a single one which is outside our ecosystem has scaled because no one actually put up their head on the table and kind of vouched for this brand, right? So all of this has happened. So yeah, so that's generally been the journey. And I personally don't know what's the skills required for raising funds, right? But maybe I've looking back at my life, maybe if I were to say what is probably one of the few reasons for the business to be successful is because I probably built a business around my core competency, right? It wasn't an idea that came to me in a coffee shop, right? As in, this is I kind of I did it for 12 years of my life, and then I exactly knew what goes behind the scene. And then, I tried to build a business, then got lucky to get a great team, got lucky for the markets to go well, got lucky that demonetization happened. So there was so many of these, right place, right time, kind of, things that happened in the hindsight. So, and yeah, it kind of worked out well, So yeah, so I mean, that's my journey, and I'd be very happy to take any questions that you might have, on anything I can share about, So.
So anyway, before we open to the floor, I have a couple of questions actually. So very wonderful talk. Obviously, bootstrapping will give you flexibility. Now that actually you guys are bootstrapped, but you have a fund and actually also invested in cred. So how was?
Okay. No, I know Kunal from Cred quite well, so, and we both have different, I think, ways, ideologies on how we think we should build businesses. And he's been extremely successful. So, Cred, the check we cut for Cred was more like, Kunal said, dude, there's a party happening. Do you want to be part of the party? I said, okay, why not? So that's about it. And I think, making some money gives you the flexibility to take these outside chances as well.
So have you ever the fundraising cross your mind? Like, okay, let us raise the funds and everything.
No, I mean, so I've met every single VCP in the world. I mean, actually, literally the world, right? As in, and
not before your profit, actually.
You mean to say in the start? No, in the start I did. I mean, I did, like, I met a bunch of VCs when we started off. And like I said, I mean, I think 2010 was a horrible time to be going around trying to build a broking business. Right? Again, in hindsight, that's probably worked out really well for us because all the brokers after the 2008 crash, were trying to go do other things in life, right? So, we got lucky with the timing that, when everyone was going out, we were trying to build it. And yeah, so I went around, and I think it was a horrible time to go out and ask money for a brokerage firm, So, and like I said, right, there was no tech. I mean, why would anyone fund someone like me, right? So yeah, so it didn't happen at that point. But then I think the good thing was for us as a business was because we were running so frugally and such a small little setup, we were a 5-member team when we started off. And I think at the end of first year, we were like 14 or 15. And no tech, nothing. It's all like people taking 15,000 rupees home and things like that. So it was just a big hustle. And so yeah, so we were kind of making some money at the end of first year. So once we started making money, and because we haven't advertised as a business till date, right? As in, so real cost of, I think, of running the business today is actually the advertising and marketing cost, right? For a B2C kind of company. And so we have said that, we will not advertise. The reason for not advertising is because people with intent to invest in the market in India is what, 5-6 million, right? Which is 0.4, 0.5% of the population, right? Whereas an Amazon, a Flipkart is probably going after 20% of the audience, right? So, but you have to pay the same advertising dollars as them, right? So how does it even make sense to compete with them, for the same space, paying 20 times more, if you actually looked at, per cost of acquisition of a customer, right? So it didn't make sense, with our pricing model. So, and also I think, being, this whole not advertising meant that we have to focus a lot more on our products, on education initiatives, because unless we constantly keep doing something new, we know that, so we have, we either have to advertise or we have to continue keeping a product ahead of the competition, right? And also in this business of stock markets and finance and investing, etc., people get introduced to the markets. It's usually through word of mouth. It's an intangible network. I started investing because a friend introduced me, right? If you actually look at it, if you find any person who's investing in the markets, there's someone who introduced him to it, right? So we said, how do you kind of tap into this? So if you have a better product, they will talk about it, right? And also, by not advertising, you're kind of building a different kind of a brand, right? I mean, if you think about it, right, which are the best, like, I mean, I don't know what's the scene right now, but like the best pubs back when I was in college were not the ones who used to advertise, right? They were the ones who will charge you a cover charge to enter, right? And
Purple Haze.
Huh?
Purple Haze.
Purple, right? So,
Or Picos.
Yeah, Picos was probably, anyone could get in, but yeah, Purple Haze was more like, there used to be a cover charge to enter and all of that, right? So,
so I have one more question. Have you ever the fear of actually the competition with a guy actually with loads of money, so that huge funding and will come actually and overtake you? That cross your mind?
No, it has. I mean, I think the last 1 year, thanks to us being so loud about how much money we make, etc., so I think we have kind of helped our competition raise money from serious guys. So there is that thing that, people could end up raising a lot of money. But the question here is, what do they do with all that money, right? The only real thing they can do is go do advertisement. Right? Now, the good thing about stock markets, again, is that you can't sell greed in an advertisement. right? Because the regulators don't allow it. You can't go out and say make 40% investing in the market, right? So greed can't attract people, right? So the only thing that can attract is that you advertise and say, I'll give you a better product, right? And also, cashbacks and stuff like that aren't allowed, right? So really, what can more money get you is the question, So yeah, so I mean, it's come across my mind. I met investors who said, if you don't take, I'll give it to someone. I said, whatever, So so it's happened quite a bit, but yeah, let's see how this all plays out.
With that note, let me open it for the questions. Yeah. People with the mic, please. Yep.
You can just raise a hand and I can just share the mic.
Yep. Yeah. Yeah.
Yeah.
Just you, please. There's a recording is going on. Use it. Yeah. There. Just press one actually.
Yeah. Hi, Nitin. Really lovely story. Enjoyed listening. I'm a very active trader as well as investor at Zerodha, and very good platform. One question that I had is, now you are the largest broker in India, right? I wanted a data that how many retail investors are really making money investing in market using Zerodha.
Okay, guys, in the interest of the topic, please keep it around the funding for the startups.
Sure.
Okay. We will call Nitin again for the subject as a subject matter expert. I hope you got my.
Yeah.
Hi Nitin, good talk. As the markets have matured in India, right? When we talk to people, we also get a sense that a lot of people want to do investment outside Indian markets. And if you look at any kind of platforms which are there for outside Indian market, I think either it doesn't exist or it's too cumbersome. And the 15-day example that you gave, right? It's even harder than that. So what are your suggestions in that area? Like, it's an area to build around it, or how do you see it?
I mean, we are building, just so we should be live with it soon. I mean, it's taken us a little longer than what it should have because, like you said, right, the real problem to solve is not the tech integration. I mean, some of the brokers in the US, the APIs are quite clean, and you can actually do that. Creating a platform allowing people to invest in the US today can actually be done in, if you're a startup thinking of doing it, you can probably be ready in 2 or 3 months. Right, so there are platforms like DryWealth, like Apex, like ETC. I mean, these are all companies that give out APIs for you to build on top of them, right? So, and there is no regulatory approvals, nothing required. So they're not even like a regulatory moat that stops you from doing it. The real problem to solve there is actually the remittance piece, right? That means if you today have, you want to buy, say, Facebook, right? And you have to send, say, $100. How do you send this $100, right? Because if you want to send it with the purpose of investing, you have to walk into a bank, sign a bunch of letters, sign a bunch of forms, and then the bank manager has an incentive to not allow you to send money out, right? So he will find a way to slow you down, right? Because he's losing your float, right? Of course, at $100 he won't probably mind, but if you're trying to send $10,000, $15,000, $20,000, which is 10, 15, 20 lakh, the bank manager has an incentive to slow you down, right? So the real problem to solve there is actually remittance. How do you get it done online? And how do you get it done online fast and lesser cost, right? Would you pay, I think today, like an Axis Bank and ICICI, all of them charge, I think, 750 to 1,000 rupees for a outward remittance, right? Like a flat fees, plus they make a pop on the currency, right? So that means only if you're really sending more than 10 lakh rupees is when it starts making sense. So what we've been spending time was actually on solving the remittance piece, right? So it's, and the tech integration in terms of all of that is already ready. We can actually potentially enable people to start placing trades on a platform anytime, actually. So it's already there in place. We are trying to now solve for the remittance because otherwise, we don't want to start this with the remittance being broken. So.
One question is, can you tell about your fund and what is the area of your investment focus for the startups? You have a fund for the startups?
No, see, the thing is, of course, we've done this outside little investments into Cred and, like Jiten's startup, this, Amica and etc. But those are more like, just being in touch with the ecosystem, and they're small little checks. The ones that we are really passionate about and which we, where
any particular area of focus you guys are in?
Just capital markets,
Just
just around savings, around investing. Anyone who potentially can grow the audience which is investing and saving in this country. right? Because see, the end of the day, I think for me personally, like if you were to ask me what's my end goal, is if potentially at the end of all of this, if we were somehow the catalyst that push people away from fixed deposit, gold, real estate into, savings, investing, which is actually helping the economy and not just being like an idle asset, So anyone who's building businesses that can get us there, is what we are looking to fund. Sorry, yeah.
That was a wonderful talk.
Around
Really
funding only,
inspiring.
please.
So I know about your investment in Sensible,
Right.
Abid. So was just curious, how difficult would it have been for you to build it out? I mean, like it's something that you could have built out in a very short period of time. So are you investing in people right now,
Right.
or are you investing in businesses?
No, it's.
Do you want to support entrepreneurs?
See, the thing is, if it was only people, we would have made it as a closed loop, right? Today, I introduce all these startups to our competitors, right? Like, for example, Sensible is plugged on 4 other brokers. Small Case is plugged on 11, 12 different brokers, right? As in, if the incentive here was to say, build it for me, and then I'll somehow close loop you so you don't go out, so, and then eventually acquire you and things like that, I wouldn't have allowed them to do that, right? So there's nothing like that. This is actually, trying to help businesses, create new businesses. Now, it seems like a thing that you could do, but it isn't that easy, right? I mean, like every small business, you need bandwidth to kind of think about every aspect of the business, right? And one of those, I don't know, it's a plus or minus of being bootstrap is that we are extremely frugal, right? As in, like, I don't want to, I don't know how many of you know it. I think our tech team is like 35 members,
Yep.
right?
So I'm going to ask about the question towards the end.
Right.
Yeah, question there.
As a startup, how can we meet you to talk more about the?
No, I
ideas?
mean, I'm meeting at least 10 to 15 startups every week, as long as it's around something. So the thing is, I think, like I keep telling this, right? Like the toughest job I have in my life right now is to somehow remain sane, right? Because people around me, because of whatever little success in terms of money, etc., they all have made me into this whole, dude, you know everything about life, right? Whereas I know that I know no shit, right? As in, it's just, maybe I know about stock markets, maybe I know about capital markets and etc., right? So it's, so around that, if there's anything, because every meeting I get into, I end up learning something, right? So if it's around savings, around investing and etc., send me an email. I'm on Nitin@Zerodha, and I'll respond immediately. So.
Okay. Last 2 questions. Yes.
Yeah. So hi Nitin. So what I have is that, as you told, you have already given a disclaimer on fundraising that we have no questions on that. What I was saying as a startup, like, when you suggest your investors that what you look in when you do actual trading is that not actually the trend analysis, but how fundamentally the company is strong. Right, that is what is a main aspect that as a genuine broker that would suggest that this company is strong because we feel that fundamentals in this company is strong. Like as a startup, where is that I can grow fundamentally strong so that I know when I see 10 years down the line, definitely my startup would be a company like how yours it is.
Right.
So what that an investor sees in a company which is fundamentally strong. That is one question.
Right.
And the second question is that it was more of a service sector in telling that you told us, but we want to know a lot about the manufacturing sector or a product-based industry. Is there anything that you can tell us on a startup, for a startup of product-based, which can be a value addition?
Right. Okay, so firstly, the first question, today when people invest at Zerodha, right, as in we don't really advise anything, as in, so yeah, we've given access to all kind of data, tools, and etc. We have still not gotten into the advisory aspect of it, right? So we don't tell our customers buy this or sell this. Why? Because the problem is I don't really know what works, right? Like if there was this rule that kind of worked, I mean, I maybe would be sitting and investing and trading through my life, right? As in, so it's tough to. The problem with the advisory, right? It is, it's one of those heads you win, tails I lose, right? That means if my advice works, you'll never give me credit, but if it doesn't work, you probably blame me through my life, right? So, so and as a business, the issue here is, we are relying on word of mouth for growing the business, and I don't want people out there, like today, none of our customers can come to me and blame me saying, dude, I lost money because of you. Of course, we've had tech issues, maybe that day the platform didn't work, probably lost money. But I'm saying no one can come to me and say someone missold me a product, someone advised me wrongly, and etc. we are probably the only broker in the country where not a single person on our team, we have a 1,200 member team today who has a revenue target. The reason there's no revenue target is because you put a revenue target, people mis-sell financial products, right? And the implications of mis-selling financial products, I don't think most financial service companies, including banks, understand, right? To make $100 of incentive, people are mis-selling $1 lakh rupees worth of product, right? So firstly, we don't do that. But now if you're coming to ask me, what should a startup do? I mean, personally, I think it should be solving a real problem. Right, as in, when I meet a lot of startups, I think they aren't really solving too many real problems out there. And then I think personally, like now that if you've already started up, how do I say? I think it's about like what has worked for me personally is I think just interacting with customers. So. Like I said, even today after 10 years, I spend 2-3 hours a day interacting with our customers, right? And it just gives extreme amounts of intelligence, to kind of direct your business wherever. And product side, I think every startup today is product based. As in, like every startup today is building a product, right? As in, so I don't know if I answered your question, but maybe we can talk later.
Yeah. Last question.
Yeah. Hi. So one thing that you mentioned is you were fortunate that you went into a direction which is your core competence, right? But not many people actually are. I mean, I thought that I had a core competence in investment banking, which I have worked for years, actually, decades basically. But my idea is not in that area, right? So how do you actually take this forward? What kind of in your experience and exposure, what would be the best way to take it forward if it's not your core competence?
Yeah, if you are building a business which is not your core competency, I have no idea actually. I've never thought about it.
Yeah.
Because like I said, I think it's like looking back. I know a lot of successful entrepreneurs today. I think. I don't know if a lot of people give credit to it, but luck is an extremely important aspect of this entire thing, right? As in, right place, right time, so is more important than everything else, right? So how do you get that right place, right time going? I think the odds of that luck hitting is higher if you're building things around your core competencies, right? So I think that's essentially what we all should be doing, is just to put ourselves in situations where the odds of hitting, when you're lucky is much higher. And so I don't know how many of you play poker, for example. If you have pocket aces, ace kings, ace queens, you need to be betting those hands and be around in those hands. It's just about that. It's about I don't know if it makes sense, but that's what I think.
It does make sense. Actually, one of our professor at NSRCL, actually, it's the bird in the hand principle in effectuation. That's what you should focus on, your core competency, where your luck goes up. With that note, one personal question outside the funding. Whereas you are into capital market, whereas Kailash is open source, which is one side is a capital market, one side is more of a open source communist kind of a thing. How is actually boardroom meeting happens?
So when we built our mobile app, right, so Kite, so I was super impressed. And then he sent me this GitHub link and he said, dude, you know what, we open source this. I said, dude, the hell? He's like, so we just put this code out for anyone else to use. I said, I don't get it. We just, so we just had this conference, which we had sponsored recently, this India OS conference. And I was sitting the day and I was listening to all these people. It's just incredible. One of those things that doesn't get mentioned as much is, okay, in-house at Zerodha, everything is in-house. We don't use a single vendor now, right? So right from our CRM to email solution to everything is in-house. That means we just run it all. We send 2 million emails, which costs us $10, right? Whereas I know my competitor to send 2 million emails is probably spending 5 cents an email, right? So it's, and the funny thing is actually Kay built this utility, it's called ListMonk, and it's open source, He said, and I said, dude, how does this work? He solved our real problem, so which was sending emails was costing us quite a bit. So he built something and he put it out in the open for everyone else to use. I said, I mean, I don't get it. Like I keep saying it, I don't get it. But
Actually, I always love your company because of you guys do the open source. That tells actually our next event is an open source for startups. With that note, I would like to invite our chairperson, Professor Venki, to give a token of appreciation to. What we give that actually the standing applause for the Nitin actually for his a wonderful talk.
Guys and girls, anybody who's interested in startups or who's already just started a venture, please reach out to us. We have several programs that can support you. So I think that's the message I want to make you leave with, okay? And we had a great talk from Nitin. Hopefully we will try to take advantage of his generosity in funding, you know?
Next, I would like to call upon Anirban. I think he's somewhere here. Yeah. Yes, Anirban is, I think, how many of you heard about the Bloom Ventures?
So that was a very inspiring talk. Nitin's left, okay. Okay. And it's quite overwhelming to speak after someone who's been an inspiration for a bunch of years and has built one of India's largest companies without any VC funding. And now I'm here talking about VC funding, which is quite funny. When you are raising funds, what should be your checklist? What are your funding options? And how should you prepare? So I took the liberty of first describing how VCs work because I think that's important for everyone to understand before you go and create your checklist on how to raise funds from VCs. So how do we work? So essentially, contrary to what most people believe, we have no money. We generally don't invest our own money. We collect money from limited partners. So limited partners are essentially HNIs, sovereign wealth funds, pension funds, banks, government bodies, etc. And after we collect that money, we charge an annual management fee, which we require for operations of our firm. And then we invest that money into the markets. Limited partners generally expect 4x of whatever money they give us. And post-investments, we try to return that money to them. And the expectation is 4x to 5x. So why am I telling you this? The reason I'm telling you this is because let's assume there's a 100 crore fund. 2% of the annual management fee around the life of the fund is around 7 to 10 years. So you essentially have 80% of that fund to invest. And since we are investing in high-risk businesses, close to 50% is generally written off. So the 80 crores of investable capital is generally 40 crores that is actually, goes out and gives us returns. And the expectation is 4x to 5x. So 400 crores is what's expected. So the 40 crore needs to give returns of close to 400 crores. So that's 10x returns is what we're expecting for. So that's the main reason why I'm telling you this, because VC money generally goes into startups that could possibly give 10x returns. So as I said, this is what we do. We essentially fundraise, we source, we invest, and then we try to add some value during the course of the startup through pushing them in the right direction, through partnership opportunities, by opening them up to our platform and community initiatives, and also help them find the talent that they require. And hopefully at some point we make some money. So how did venture capital start? So essentially the roots of venture capital, funnily, it just rests in whaling. So back in the 19th century, 1800s or so, you used to have whaling expeditions that used to go out. And you had specialized agents collecting money from rich investors, and they used to find captains and crew to execute these whaling expeditions. And funnily, I mean, most of the venture capital firms today are structured exactly around whaling agents. Like they used to syndicate investments, they used to have ownership structures that are very similar to today's day and age. And the modern venture capital as we know it took shape with Georges Doriot and Arthur Rock. That was the first big venture capital investment in Fairchild Semiconductors. Arthur Rock went and invested in Apple Computers, Scientific Data Systems, etc. Fairchild Semiconductors was the first institutional investment through a venture capital fund. And from Fairchild Semiconductors, we have firms like Intel, AMD, LSI Logic, Altera, collectively worth around $3.1 trillion that have emerged. Just from a $1.5 million investment, you've generated wealth of close to $3.1 trillion. And as you know it, the top 5 companies in the world, they're all venture funded, collectively over $4 trillion. So the main reason why I'm telling you all of this is because the point that I'm trying to set is that most of the investments we make are going to go into startups that can deliver exponential returns. So because 6% of our deals produce 60% of the returns of the fund, and most of our investments are going to go into startups that can generate exponential returns. So I just wanted to, since I'm here, I think it would be slightly unfair to not do some marketing for the firm. So we are Bloom Ventures. Our first fund was around 100 crores. We right now have close to $200 million in AUM, invest in the market. Over a period of the past 10 years, we've had a few exits. And right now, our present third fund is around $100 million. We generally invest seed to pre-series A. And now let's get into the topic for the morning. So founder's checklist for startup funding. So I think the biggest thing that you need to focus on is the problem you're solving. As Nitin had said, are you solving a problem that is a problem for other people as well? And how many people face that problem? So if you think about Ola, Uber, everyone faces a problem when it comes to commuting, right? And so that's a big problem. So if you try, recently I got a pitch from a dog walking company. They were trying to replicate exactly what a company in the US, which has been funded $350 million, is doing. They basically are providing someone to walk their dogs. So is that a problem in India? Definitely not. So you need to focus on, is that the problem you're solving, is it a big enough problem? And next is, what does it take to solve it? Do you have the skill sets? Do you have the know-how to solve that problem? And most importantly, you need to know your limitations when you're trying to solve a problem. Like as was said in the last talk, core competencies are definitely very important because not everyone can solve a problem that they don't have the skills for. Like I know Harsha from Swiggy, he had never worked in food before, but he solved a huge problem. There would be exceptions, but more often than not, you need to focus on your core competencies. So the next thing is, do you have the right founding team? Does the founding team have the tenacity to stick through the, the tough times of building a startup? It's a very tough experience. I've tried it on my own. It's extremely tough, and most people tend to take the easier way out. I did that. So you need a lot of tenacity. So does your team have that? The next thing is the opportunity cost. So what is each member in your team giving up to sit there, spend 2 to 3 years without any income? Probably when funding comes in, you'll probably be able to draw a salary, but there is an opportunity cost involved. And everyone has families, everyone has financial responsibilities. So someone has an opportunity cost. Like for example, if one of your founding team members has the opportunity to work in a job that gives them 1 crore a year, would they stick on when for 2 to 3 years they're not earning any money? So is it worth their while? So opportunity cost definitely matters. The adaptability that they have. A startup requires multiple pivots. Most startups have pivoted over and over again. So your team needs to be adaptable enough. Skill set, which is your core competencies, definitely matter. And the track record. When you're trying to look for funding, generally VCs look at your track record. There are exceptions where people have been funded straight out of college, but that's a sheer belief in the tenacity of the founder. So track record definitely matters. The next thing that you need to focus on when you're building your founding team is, are they incentivized enough? So when I say incentivized enough, do they have enough skin in the game? Are they being given enough ESOPs? Are they in a position where they can stick through you throughout your journey? Because you need to incentivize them enough for that. The next thing, probably I spoke about it before, are you going for boundaries or are you going for averages? Like, it's brilliant to build a business that's a lifestyle business, and it's probably the noblest thing to do. However, if you're looking for VC money, we would always push you for the home runs because that's the only way we are going to make some money. But you should definitely find a fit in terms of where you're raising your capital from. And if you're going for the averages, you should probably look at other sources of funding. Now, the fourth thing is your competitive advantage. And what can you learn from your larger incumbents? So you cannot build a disruptive business unless you are unless there's some differentiation. The differentiation can come in the form of price. There could be a white space that you're entering. You could have a first mover advantage. You could be entering a unique market. There could be a unique distribution structure in that market. So there could be a lot of things, but you need to figure out what your competitive advantage is. And in addition, when I say larger incumbents, when you're building a startup, you're generally trying to disrupt something or you're building something new. Like for example, Swiggy tried to build something new. Zerodha actually disrupted the existing incumbents, right? So what can you learn from your larger incumbents that you're trying to disrupt? How would they react? You should have some sort of an understanding of that in your checklist when you're building your startup out. So there's one more thing that most VCs, or rather most startups do not talk about. They believe that they acquire enough customers, they'll figure out a revenue model, and there'll be a path to profitability. But in today's day, it's very important to have a path to profitability. At the end of the day, to build a sustainable business, there are only two things that matter, which is your revenue and your cost. So you need to figure out what your average revenue is going to be, what your acquisition cost is going to be, your unit economics, etc. First few years, it's okay to not make money, but that cannot extend for a very long time, as you would have seen with the debacles that are happening in when privately funded VC startups are trying to enter the public market. So that's a major focus, and you should have that at the top of your mind when you're trying to build your company out. And realistic budgeting and financial modeling for the length of the enterprise. So we get a lot of pitches where folks claim to have a GMV, like recently we got a pitch from a agri-commodities company that's claiming to have a GMV of close to 50,000 crores in the next 3 years. They are at zero right now. So how on earth is that going to happen? So you need to be realistic with your budgeting and financial modeling, because folks see through it. And the last thing is your valuation exit scenario. So whenever you seek VC money, angel money, or whatever kind of investment you're seeking from external sources, from the private markets, you need to provide an exit to your to your investors, and not just to your investors, your employees, yourself to a certain extent. So you need to have some view, or rather you should have thought it out as to how you're going to exit. Is it going to be through an IPO, an M&A? And how would that startup financing method that you select dilute your ownership? So the valuation would play a major role in that, because the lesser your value, the more dilution you'll face at each and every round. And you do not want to be in a position where 5 years down the line you have 5% stake in your company and you don't have enough skin in the game. You might exit yourself, and the company might just fold. You might not have enough decision-making abilities. So you need to focus on how much you're diluting at each round, and valuation will play a major role over there. And when you're trying to plan your exit, what metrics you need to achieve for that, and when are you going to achieve for that? When are you going to achieve that? So this is an overall checklist. I'm sure there are multiple other things that you need to look at, but when you're looking at startup funding, these are the things that you definitely should cover. So what are the imperatives for investors at each stage of funding? At the seed, pre-series A stage is primarily focused on team, market size. When you're reaching series A, definitely product market fit needs to be achieved. Your unit economics at scale need to work. Need not work at that particular stage, but there needs to be a path to the unit economics working. Series B is all about meeting your metrics, achieving growth and scale. And Series C onwards, most investors are looking at whether this firm has a path to profitability, which, I mean, the newspapers may not suggest that, but definitely investors are looking at that. And is there a path to exit? So how do we evaluate a startup at Bloom? Since we are a pre-series A seed stage, where we cut checks of around, our sweet spot is around 700K to 1.2 million. It's more of an art. It's more of an art. We look at the team, we look at whether they're solving a large enough problem, whether the team is capable of solving that large enough problem, whether the product that they're trying to build is going to solve that problem, is it meeting the needs of the market that they're targeting. So that's essentially what we are looking at, and as well as whether this can become a $500 million startup, because we are a $100 million fund. So the kind of exit we want is dependent upon the fund size. So, so for us, it's focusing on a $500 million. Can this be a $500 million startup? For others like Sequoia, for larger funds, which are like $400, $500 million funds, they're probably targeting companies that can become $2 billion companies, because the size of the fund is directly proportional to, or rather the exit is directly proportional to what they're looking for. So, firstly, like what is a startup? Startup is generally a business. Every startup need not be a cash-burning, beast. Like, that's something that I think everyone needs to be clear about. And there are multiple funding options for startups. And VC money is just probably 1% of the overall, capital that's out there for building a business. So it's very important to be driven by the business you're building, not the fundraise you're achieving. So you can start with personal investment, their friends and family, there's crowdfunding, there's incubators. You can also take business loans. So there are multiple routes of building a startup, and getting obsessed in this entire VC game may not be the best idea when you are trying to build a company. Focus on the business you're building is probably more important. And one of the most, and probably the noblest things to do is build a business where you don't require someone to take equity, right? Because that's when you are actually building a real sustainable business. So think about that. So now I'll quickly cover what are the funding options for startups when you are trying to raise capital by giving away equity, right? The first step that most folks follow is investing their own money. Generally, that's around 10 lakh rupees. This is the easiest because it's your own money. Raising is the easiest. You have a high hope of return. You have much more involvement at every stage, but you put your financial security at stake. So you cannot do that beyond a certain amount, depending upon your limitations. Generally, it's around 10 lakh rupees is what we've seen. Then you can go to your friends and family. I call this love money. They give it quite easily. You'll have to convince them a bit, but they would give it. And they're far more forgiving than external investors. They have low involvement, but again, you put your relationships at stake over here. The other thing is professional angels. They are reasonably difficult to find. It takes quite some time. So this is like at a seed stage or pre-seed stage. They generally take some time in closing. They have very hawkish expectations. There's a lot of expectations on returns. You tend to dilute a lot. They're mostly hands-off. But there are larger angel networks that work very professionally, so you might want to consider working with them. Then there are venture capitalists. And I would say this is one of the toughest because it requires a lot of due diligence, requires a lot of time to close. They generally maintain long-term relationships because when they're generally in for like 5 to 7 years. So it's probably one of the toughest to close. The advantage is that they come with their own networks. Most VCs have their own networks. They have professional management. But again, there's a huge disadvantage, which is they push you to grow faster because, as I said before, we are all looking for 10x returns. And growing fast for a business can be, very detrimental to a lot of businesses. So that's something that you might want to consider. So these are the stages of evolution of a startup. At the seed stage, and I've put down the benchmark metrics, and obviously these are indicative. It's not written in stone. Things are changing. I mean, things are going through a turmoil. Like initially during the hyperfunding stage of 2016, probably none of these would hold. But right now, we are coming back to a stage where most of this would hold. So if you're doing e-commerce at C stage, your GMV should be around 0 to 1 lakh. The round size is 50 lakhs, around 50 lakhs or so. Dilution is 10 to 20%, so on and so forth. So this is for you all to understand how much you'll dilute at each stage. So, and it's generally advisable to avoid major dilution till you're close to product market fit. Because if you dilute, by the time if you are at pre-series A, if you diluted close to 40-odd%, then why are you even involved in that business? You don't have enough skin in the game. You'll probably not be motivated enough to carry on building the business when you are raising a Series B, Series C, etc. So these are the typical round sizes, few of the venture firms that operate in each of these regions. So we at Bloom operated around, we cut checks anywhere between 300K to 2 million. And we fit in at seed and pre-series A stage. Right now our check sizes are around 750K, but we also go below and sometimes push it above 1 million as well. Yeah, so how do you prepare to raise capital? So the first thing that everyone should keep in mind that fundraising is a very exhausting process, and you need to buy yourself as much time as possible, especially if you're building a business that requires venture funding. If you're putting in your own money, it's a different story altogether. So you need to understand the VC firms in the market, assess your fit, because not every VC firm is ideal for you. There would be VC firms that that may not have the same portfolio or sector preferences that you are in, and they may not be able to add much value in terms of follow-on rounds, the community, their platform. So communities, they connect you with, so VC generally have a community and platform model where they connect you with different startups, connect you with different corporates that help you grow your business. So you need to figure out what the track record of the VC has been, what is the value add that investor adds, because just because they're giving you money, that doesn't mean that's money you should take. So you need to understand what their preferences are, what fits in really well for you. So create your investor list and then approach each of them individually. Find common connects and referrals. It's quite, I would say most people in the ecosystem right now are very, very responsive. And everyone's out there to help each other, whether it's startup founders or venture capital investors or even people running accelerators. So be a part of that ecosystem, find common connects, reach out to people on social media, create a social media presence for your startup, you know, be out there, create some form of presence, ask for advice. Everyone's out there to help. So you need to be heard before you try and raise some money. As I said, plan ahead and start early. Don't underestimate the time it requires, because I've seen a lot of startups fold. You know, they've shut shop because they started late. They had pretty good business models, but they didn't have the runway to sustain it. Have the right advisors, because these advisors will help you at each round of investments. They will help you with refining your business model, refining your pitch to investors, pitch to as many people as possible, because that's how you'll refine your pitch. The flaws in what you're trying to execute might come up. And I'm obviously talking about seed stage and pre-series A. And eventually, when you reach Series A, Series B, you'll be much more refined in the entire process. You need to have some opinion on the structure of entity, because right now we see a lot of B2B SaaS startups. We see a lot of cross-border startups that are coming up. So you need to have a view on whether it should be an Indian entity or an overseas entity. We face a lot of issues with companies that have registered as Indian entities or a Delaware C Corp, and then they want to flip over. You know, wiring in investments can be a huge challenge for that. So probably if you might want to hold on to registering the company to a certain stage before seeking money. Have your pitching material ready, whether it's your projections, follow-up materials that investors might require, the pitch deck, etc. So have all of that ready. At least 8 to 9 months before you start pitching. So this is the general information that investors request. The most important thing is your addressable market. So the total addressable market of the opportunity that you're trying to solve, of the problem you're trying to solve. So, and what is the market that you will be able to target with your present offering? So this is the first thing that that most VCs ask for in their pitch, and what kind of a share you will be able to take of that market. So without that, it's generally difficult to gauge the problem you're solving and what's the size of it. the product details and what kind of a roadmap you have of products, because it's important to know what are the technical details, because it gives you some idea, or gives us some idea of what are the moats that you're developing, how difficult it's for someone else to build it, and if you're actually solving a real problem through your product. So your product details and technical aspects of the product should definitely be there. And the time you would require to take that product to market is also very relevant. Details of your management team, what kind of domain experience they have, the key team members, and some understanding on why you think they would be able to execute on the problem you're solving. Then what kind of additions you need to ensure that you have a strong management team. So that also is something we look for in your pitch decks. We would like to look at what kind of traction you've made, whether you have a minimum viable product, if you have an MVP ready, you have pilot customers, you have any strategic partnerships, any customer testimonials, etc. Next thing is how you would utilize our invested capital. Like if we are putting in $1 million in you, how this would be split across every aspect of your business, whether it's engineering, whether it's marketing, whether you require money for CapEx. It helps us gauge what kind of capital efficiency would be there in the business. And whatever differentiated technology and intellectual property you're building, details of that is something we look for. What is the advantage over the existing tech? What is the cost or skill to execute what you're trying to build? And how difficult is it for someone else to build it out from a technology front? So that's also something. If there are any patents, copyrights, trade secrets, that's something you should definitely highlight, because it gives your company a certain premium on the valuation. Who owns the IP? Is it your employees, or is it in the name of the company? Are you infringing on the patents of anyone else? Is also very relevant. The financial projections, your legal issues, all of that should be there. And as I said before, the valuation exit scenarios. So I'm opening it up for Q&A. If there are any questions, happy to take them.
Okay, we have time for actually the 2 or 3 questions. Please raise your hands. Please pass on the, yep. Here, one here, one, no, just hold on. Here, one here and one there.
Hi, thank you so much for sharing the details. My question is, you stressed quite a lot on the problem you're solving, the nicheness of the idea. How difficult it is to get funding for a setup which is a good business going on, say in a services domain, or in a catering business, or in a hotel domain. How difficult is to get funding for something which is stable and is going on? And it's a common thing to execute.
It's not difficult at all, I would say. So as I said, I mean, like, if you're trying to build a business and you're trying to seek VC money, it's important for you to keep in mind what VCs are looking for. So we are looking for 10x returns. So if you're doing a catering business, that's fantastic. It's probably one of the noblest businesses to do. And there are multiple sources of funding for that. And there needs to be something that you're disrupting when you're building a VC, when you're trying to seek VC money. And there are multiple sources of funding. It need not be VC money is the point I'm trying to say. So if you're trying to look for funding, there are multiple sources. There are bank loans, there are different grants that are there for small businesses. So it need not be VC money. You might want to ask yourself why you want VC money, right? VCs are going to push you. They're trying to push you to grow. And it may not be the best practice for your business.
Okay, makes sense. Okay. Thanks.
Yeah, question there.
Thank you very much. My question is on what kind of time frames would this engagement from pitching to actually getting funding takes? And the second question is when we are sharing what level of information needs to be shared, and how is this be kept in confidence with the VCs?
Okay.
Thank you.
So in terms of timelines, depends upon how much interest is there in your business, I would say. So there have been deals that we've executed in literally 20 days, right? Because we were sure from get-go that, hey, this is going to be something that we are really aligned with, we are really interested in it. It gets executed 20 odd days. But generally, it's around 2 to 3 months, I would say. from when you've pitched to execution, because we need to do due diligence, we need to understand your business, understand the customers, etc. Your second question was around, I mean, like, depends upon, I would say no VC that I know of, I know most of the VCs in the market would ever divulge information on your pitch decks. And to be honest, like, what do they achieve? So VCs receive close to around 2,000 pitches a year. So what are they going to do with each of these 2,000? There's not much value because everything is execution. There is, I mean, a business plan can be great, but there is no unique idea. At any given point in time, there are probably 5 people coming up with the same idea. So it's more about how you execute. No one's going to steal your ideas, and that doesn't happen.
Yeah. The question there?
Yeah. Thank you for your session. My question is that you said that angel investors also give seed capitals, right? So will be the same equity they will be asking for the seed capital? That is one question.
No, just keep it one question. We have
just
only one question.
It will not a big answer, sir. Just I want to have a mentoring about this VC. Is it possible, IMB?
Yeah,
sure.
Just let's have.
Okay, thank you.
Yeah.
Sure, we can do that.
Your question is actually whether
seed capital will be asking for the equity again.
Yeah, they would. I mean, like, angel investors generally, in fact, even if you're raising money from your friends and family, you should give them some form of equity, or you should have an understanding with them that you're going to return the money in a particular period of time. Angel investors always take equity. Most angel investors that I know, they take equity, and they generally expect the returns a bit faster because there are many startups that have a very crowded cap table, and even your follow-on investors would like you to help them, make the cap table a bit less crowded. So angel investors generally have sooner exits as well, and they take equity. As I had a slide in which I had spoken about, it generally depends upon the angel. 10 to 15% is not very uncommon.
Sure. Okay, here. Last two questions here, and yeah.
All right. So my question is a little more general. I have a social-minded enterprise wherein we have innovated a machine to eradicate manual scavenging. So, so we don't see exactly giving back 10 times the returns. So where do you suggest? How do I approach, and whom do I approach for funds?
Yeah, I think he mentioned about the government funds, and you mentioned about the various social causes. There are a lot of philanthropic funds are there.
Government funds we have applied for, but it's a little difficult.
Absolutely.
There.
No, see, you're trying to eliminate manual scavenging. I wouldn't say that's a business that is just a social enterprise. You're solving a real problem, and it's a big problem. Try to figure if it's a big enough problem. How many people, in India it may not be as big because although there are laws that have been passed against manual scavenging,
yeah.
there have been laws that were passed in 2013, if I'm not mistaken. But, I mean, will the government be ready to pay for something like that? Will they, like, it's probably a robot that you're trying to build, or is it something?
It's not exactly a robot, it's a machine which will pump out the waste. So it's a different mechanics that we're using here.
Sure. So we can talk about it offline. I mean, I don't think it's a small problem at all.
All right.
So you might want to explore it from that point of view also.
Yeah. Hi, Anirvan.
Yeah,
my question is, generally a fund has a life, right? Say, for example, 5 years or 6 years.
Yeah.
So if it's approaching its end and you have put up money and they don't get a return from a particular startup, what's the thought process behind it, and what's the approach generally you guys take at that point of time? Close to end of the term.
So you are the LP. You are the limited partner.
No, I'm an investee. And suppose you are a fund, and your fund size fund has a life of 5 years. You wanted an exit as per the SHA in 5 years, but that's not happening. So what would be your thought process around 5 years?
A very interesting question. My answer could raise a lot of eyebrows. So generally what VCs do is they have a discussion with the founders, and there is a certain amount of understanding between founders and VCs that, hey, we've invested in you for 5 to 7 years. We require an exit after a particular time. That's provided the company is at a stage where it's not growing anymore. There could be multiple routes of exit, but you don't force them to exit because there is no clause that allows us to force them to exit at all. Having said that, ILPs are not hell-bent on getting their money back. As long as they know that the money is invested in a particular company that's doing well, that's good enough for them. So it's not like after 5 years we have to return every single penny.
There would be some restructuring.
There will be some form of restructuring that would happen.
Okay.
Thank you.
With that note, thank you very much, Nirvan. Actually, so we.
Thank you. Thank you. Thank you.
Guys, okay, we are going for a break. We will post break. We have a one angel investor, one VC, and as well as three entrepreneurs doing the panel discussion, demystifying funding for startup. So if you're looking for a incubation, or if you're looking for the launchpad, or any confusion you have with your startup, actually you can write to ideas@nsrcell.org for a mentoring session. Okay, so please take down the email ID. With that note, actually, let me quickly introduce you to the panel. I will not take much time. To start with it, actually, Amit Singh, I know him for a long time. We co-founded Head Start Network together. Actually, currently he runs WOW Labs. He's a co-founder, CEO of the WOW Labs. He will be moderating this session. Okay. So next to him, actually, we have a Sunil Maheshwari, actually, NSRCell incubated company, Mango Technologies, or I still remember by Mango Technologies. He sold his product to the Qualcomm. So he's co-founder, CEO of the Mango Technologies. Next to him, we have a mentor in residence, angel investor, part of Indian Angel Network, Naga Prakasam. Okay. Then we have Avinash Sharab, actually, who's co-founder, CEO of Zuzubi. He raised capital twice and he sold his company twice, 2 exits. That's great, actually. So you can also ask the question. And last but not the least, our own, actually, Parag, who's managing director of the Inventors Capital. Actually, they are invested in Redbuzz, Policy Bazaar, there are a lot of other things, which is, and recently they raised new fund, actually. I don't know which areas they are investing, but previously they used to invest in almost all areas. Okay, with that, actually, let me open the floor to Amit. Over to Amit.
Thank you, Keshav. Hello and good morning, good afternoon, everybody. Okay, I'll share a little about myself. I build technology products for a living. I have also co-founded Head Start Network, which is an early-stage startup community spread across the country. Been doing a lot of startup events and connecting a lot of people together for over 12 years now. Before we start with the panel, we'd love to get a sense of who are all you amazing people over here, investing a good part of your Saturday morning, coming here to learn about entrepreneurship and fundraising. So how many aspiring entrepreneurs here? Okay, sizable chunk. How many existing entrepreneurs here? Okay, fantastic. How many people who have started up in the last 2 years? Great. Who started up for 5 years? Great. 5 years and more? All right, wonderful. So that gives us a sense of who our audience is. How many of you will not raise your hand no matter what question I ask? Appreciate the honesty. So that's not coming. So let me introduce our panel a little more. Keshav has given a fantastic brief introduction. To my right is Sunil Maheshwari. He started Mango Tech over a decade ago, right from IIM Bangalore. Back in 2008, when Google acquired Android and it was becoming really popular, we guys used to ask ourselves, hey, our Mango Tech had this tech as well. And beyond that, he has been an early investor in Aton RP. He's also right now co-founded Triumph Tech, and Triumph Tech has cutting-edge technology for gaming, multiplayer gaming especially. To Sunil's right is Naga Prakasam. He is one of India's most prolific angels, one of the founding members of the Impact Fund at Indian Angel Network. He's a partner at Acumen. And I'll have to read out all the startups that he sits on the board of. And okay, it's going to be a pretty long list. Plus, I accidentally closed my tab. So, but it's a real long list, guys. Yeah. So to his right is Avinash Sarab, and he has built 2 companies, and he's on to his 3rd one already. His first company, Zujubee, launched in 2014, raised about $1 million. It was a corporate employee mindfulness and healthcare technology solution. And it got 50 really big clients in India, about 5 lakh users overall, sold it in 2017, started his next company called Aware, which is a mobile application with a lot of guided meditation videos. It did top 5 in US and India in the app stores, over 5 lakh users again over there, sold it in 2019, on to his 3rd venture. So there's like a fantastic experience from building entire startups, raising money. For the second venture, for Aware as well, he raised about $3 million. And all the way to exit. That's what we can totally look forward to from Avinash. And we have Parag Dole, of course. He a very well-known figure in the Indian startup circuit. He is a managing partner at Inventus India Partners. And he started his career into venture capital, in 1993, ICICI Ventures and beyond. And he sits in a, as a board director in a bunch of companies like Visuary. This one I have not closed the tab, so I can totally read out. So Funds India, Visuary, Power to SME, Policy Bazaar, eDreams, Avaz, Spielworks, and Tricog. So, maybe have a small welcome applause for our panelists. Okay, so this session is all about fundraising. What we want to leave you with is getting a good sense of what makes your startup fundable right in the early stages when you're looking for angel investment, and as you mature, what would a venture capitalist look at? Probably if you get a clear sense of, is my startup fundable or not fundable? In the previous session, you did learn about bootstrapping your way to all the way through, right? So if in case that happens, great. So without further ado, my first question will be to Naga. Naga, what are the key parameters that you look for while investing in an early stage startup as an angel investor? With every trait or principle, I would love if you could share a small example of one of the startups that you have invested in.
Yeah. So in general, my views are going to be a little different because I do focus on what I call social businesses. So there are 3 categories of Indian startup, right? The first category is the copycats. These guys look at what's happening in Silicon Valley, start writing a business plan. There is 100 guys now probably 1 or 2 will survive, right? So that's 85 e-commerce company at one point. Now there is every startup in Bangalore has a domain.ai, right? They think that you have a domain, you have an AI. So whatever the trending, this is the first category. It is a gamble, right? You 100 guys try, the 1 will survive. So that's one kind of category. That's the glamorous part, but that's where most of the action is, more entrepreneurs, more investors, everything in that place. The second category, what I call, is about the playing on India's strength, right? So what do you think is the strength, our strength? India's strength, huh? People, yeah, what else? Agriculture. 2,000 people leave agriculture every day. Diversity, we send all the Northeast back, yeah? So we ran like 2-3 trains extra, right? We pushed them back. So this is where, all these things, what I call these problems are all opportunities, right? And you pick a problem, start solving it, bring technology. Technology doesn't mean the Bangalore definition of technology. So what is Bangalore definition of tech? App, right? So it's 400 million people do not have electricity, sir, I will write an app to track all of them. So that's the answer for all these guys. So bring tech means physics, biology, anything, right? Whatever we are learning, just apply. So if that technology help you to scale, if every Indian pay you rupee, you have a billion rupee company, right? We are a sachet country. So that is where my focus is. I'll give you a quick example of Unifor. So this company worked on speech recognition, right? India probably, how many people speak English in India? Any idea? How many people speak English? 10 million? 29%? So that's a problem. We have a data problem now, we work on AI, right? So without the data, how the AI is going to work? So we have all opinions, right? We have no data. Whoever is shouting the opinion far higher, loudest, that's the data, right? So 250 million do not speak English in India after 400 years of brainwash. That's what Unifor did. He said that billion people do not speak English. There are 765 languages in this country. How are they communicating? No script, through voice, right? He did a voice recognition. He developed a technology with IIT Chennai, which can understand hundreds of dialects and 20 Indian languages. So he was rejected by 20 investors. They said that, what is this? You are working for some farmers and tribals. There's no scalable model. There's no business in it, right? But what I liked is the perseverance. When I met him, he was a 5-year-old company. There are please few 5 years. But he was on it, on the technology, never gave up. That perseverance, what I loved it. I said, I'm going to fund you because when 20 people told that you're stupid, you did not listen to them, right? So he was on it. And the next year, Time Magazine recognized him as a millionaire, 13 millionaire changing the world. Only one person from India, that's Umesh. Because he's putting billion people on the digital revolution, right? 40 lakhs farmers were getting his voice call every day, getting a weather forecast. The tribal women in Gujarat can pick up a phone, do an entire bank transaction, use your voice. Because your voice is your biometric, right? So this is what the perseverance could pay off, right? And the technology, 5 years he was working on, he was listening to 25,000 hours of voice. The John Chambers saw that Time Magazine article, he wrote a $10 million check. So this is what the investment is, right? You pick a problem, that problem is valid, you may be ahead of your time, then don't pivot. But if you're in the first category, if Ola starts eats and the Uber starts eat, then Ola has to do a eat. And he does something, you do something. So if you do a copycat model, you have to keep copying what these guys are doing. But if your problem statement is valid and your solution is original, you be there, and if it is scalable, there are people. But we need a perseverance. That's why you need to see what kind of an entrepreneur are. There is one kind which is entrepreneurship is life. The other kind, saw the Economic Times yesterday, your batchmate, selling T-shirts, raised $2 million, you lost sleep. You start writing a business plan, right? So if that category, you write the first category, try your luck, right? But if you're the first category of entrepreneurs and work on a serious problem, there are amazing kind of problems out there, do solve it. That's what I do invest. So today, speech recognition, who is his competition? Google. A guy from Chennai solving India's problem, competing with Google with billions of dollars of R&D budget. So money isn't everything. Money is one element, right? All the best.
Thank you. So, Sunil, could you highlight about how should founders go approaching angels during, when do they know they are ready? How do they go about approaching their first investor for the first check?
Yeah, I think it was wonderful gyan, I would say, from Naga. And so what kind of things he is looking for. So he has already answered one part of this question. The second thing is, many people here, they are aspiring entrepreneurs, and some of them have already taken that step. So I would say first thing is, whatever your idea is, you have to put it on paper, number one, and then go and meet as many people as possible, right? So when you meet people, you refine. It's not about, say, I'm talking about a pre-funding kind of stage where, right? So you refine your own thought process, because you have to, say, we live in our own echo chambers, and then we believe that whatever we are doing is going to change the world. And in many cases, because we are living with that idea day in, day out, we believe that everybody going to need those kind of things. But then people might have different kind of, say, he has given example about Unifor and voice recognition in Indian languages and other things. If you ask people on street, people would say in India, everybody knows basic English. You don't need the Indian language recognition for basic banking related thing. And that's what Unifor does, right? So they support banks and other organizations. So number one thing is, you build your proposition on paper, you meet, you talk about this thing, and you see that how they are receiving. You may have a great idea, but then if you are not able to communicate, then you would learn what kind of cues people are taking from your discussion, your talk. So you will get pointers, you will get keywords from people that, okay, they are giving more value to certain things. They are actually recognizing certain keywords more than something else. Because, say, I come from technology background, and many of us come from technology background here in Bangalore. So we give lots of importance to technology than the business, than the dhanda, right? So if you don't, and in the morning session, I was listening to Nitin, and he was saying that he built the business on Excel sheet initially, right? The technology product came very late in the cycle, correct? So you can do business with Excel sheet, right? If your business demand technology, if business demand something else, then you have to build. But obviously, what I'm saying is you have to think that, okay, how technology can be used for business, for solving a problem, right? Or solving a technology-related thing. So that is the number one thing. So you have to build, meet people, get the feedback, incorporate that feedback, again go out, meet people, show whatever prototypes you have. So you will get good or bad, both kind of feedbacks, and you will say, okay, I'm liking, say, I remember that when I used to go and meet people for initial round of funding in Mango Technologies, I met almost like 100 people who, and I always believed that the first, why he is not putting in money, right? I have such a great idea. He is talking about Android and other things. We are also building same kind of platform. But then you have to understand that this person who is sitting, who is having money, what is he thinking? So is he doubting on your capability to build a platform which can compete at global level? And how are you going to assure him that, yes, you can compete with somebody who is building a global product? Like, say you mentioned about the Google competition with Google. So that's the most important.
Got that. Avinash, you've got some points to add on approaching investors for your first check. At what stage of maturity should you be as a startup?
What maturity should a startup be at in order to raise investment? I think investment is always an outcome of the objective that you're pursuing as an entrepreneur, right? And if you look at the system level definitions of what an enterprise is, what is the goal of an enterprise? The goal of an enterprise is to make money. End of the day, whether you like it or not, whether you want money for yourself or not, that's a different thing. But if you're building a business, the goal of the business is to be sustainable, to be profitable, and so on. And so as long as you're true to those fundamentals and you build with that intent, I think investment is something that comes along during that journey. My view has always been that it should not be the objective that you pursue. The objective that you always pursue is to build a great business. And if the business requires investment, and if you have pursued the objective with great intent and with good foundations, then raising investment should not be that big a challenge. Now, when I say good foundations, essentially in my learning, there are three things which become really important. One is the team that, so you need to lock into three things, basically. One is the team that has the capability to execute on the idea. Second is the nature of the idea itself. It should be a valid idea, as Naga was saying. Many a times, for most of us, entrepreneurs are very passionate people, and most of the times the ideas that we have are just made up ideas in our head. There's no real world significance for that. And so it's very important that you lock into a problem that really exists, is valid, is urgent, and you're solving those problems. And the third is having a repeatable sales and marketing playbook, which means do you have a way, a methodical, repeatable way to find, convert, and retain customers. When you have all these three things in place, then you can either choose to raise investment or you can sustain yourself on the revenues that you're generating. If you do choose to raise investment, then these three foundations are going to be of great help to you. And I think those three anyways you'll need. So you build with the intent of building good business with solid foundations, with some of the things and anything else that you learn in the process. And investment, at least my experience has been that it comes along if you have a good business.
Sure, thank you. Parag, why don't you cover all the things which have not been covered so far?
That's a hard one. I think team was mentioned a few times. I wanted to delve in a bit deeper with an example. We have this company called Tricog, which is on its way to becoming a success, not a success yet, like a Policybazaar or a Redbus, for example. But there are 4 people who started the company. They basically do ECGs on the cloud. So think about sending the ECG signal up to the cloud, and the machine reads it and thus solves the problem of turnaround time. In India, the basic problem is that a heart attack victim gets served on an average between 4 to 7 hours, whereas in international countries, most Western countries, the protocol is an hour. If you target that problem in an hour, you save the life. 80% of the time you save the life. So that's the problem that they were solving. It is a team which consists of an interventional cardiologist, 2 PhDs, one in signal processing, the other in machine learning, and a 4th guy on the software side. You rarely come across a team as diverse and competent and relevant to the problem as that. So when we found this team, more than anything else, more than the size of the problem, etc., size of the problem is also large. But this was what attracted us. These guys knew. All 4 of them knew nothing about business. They almost didn't know what ARR was. They didn't know how to set up a sales team, etc., etc. But we backed them simply because exceptional first principle thinkers. 2 of them, and I'm decent at mathematics, etc., etc. 2 of them, and I've been doing metrics all my life, in the sense that I've been a VC all my life. These guys are now better than me at their metrics, by far. You look at their dashboards, their real time, the way they think about their business in terms of mathematical precision is just awesome. So that's what I mean by a team, a depth, people coming together, high caliber people coming together, staying together, and tackling a problem that is large and big. That's what we look for. So those are the 3 big criteria, if you will, for a VC, which is an inevitable question. One is the team, which I delved into a bit. The second is a large and growing market. And the third is what difference do you bring to the table? Are you just another solution in the market, or how do you differentiate yourself? So I think the first one is the key for early stage investors like us. We are not as early stage as Anaga is, but we are fairly early stage, 15 to 30 months into a company's growth.
Thank you, Parag. So a bunch of things over there. Founders really need to believe in their business and put whatever there is at stake, and this probably encourages angels to want to bet on you. While starting a business, it's always great to go ahead and talk to users, actual customers, instead of sitting up and creating theoretical versions of the same, and that's probably going to lead to success. Then Avinash shared a fantastic thing about having your team sorted, having a playbook for marketing and sales. What was the second one? Yeah, and attacking a problem that is really urgent in the market right now is pretty important. And Parag touched upon, more about team, a team of A players, a team with complementary skill sets, addressing a need which is in a big, fast-growing market is extremely critical, and what people look at while funding. Now let's look at what are the standard rejection criteria. Okay, you've already touched upon them a little bit, Naga. Could you share a few more instances on, if you see this, it's a red flag for you and you would not consider investing?
So I think the one is about what Parag was mentioning and the complementary skills, right? This is kind of changing. Like 10 years back in our angel meeting, we used to joke that we should get 100 people from Gujarat and drop it in Bangalore, right? Because all these guys with the tech stuff, they have no clue about sales. So we have done some of this where it's pure techies, they don't have thick skin as a salesperson and have that not to take no as an answer, that attitude, that is one. The second is about So we are the first maybe and kind of institutional people, right? We are proper people because before us coming in, these guys would have taken money from their friends, family, and future and father-in-laws and stuff. So there is a kind of a very clumsy system they will have, right? There is no proper structure into it. Wife is there, my uncle is there, all that stuff. So we try to come in and then say have a proper governing structure, get that cleaned up. That is the second, where we have seen cases that cash moved into the company, saying that my father gave, cash into a company is a big, big no-no. Okay, when you do a DD, it's a problem. The second. The third is, I think probably the most important is that integrity of this entrepreneur, right? Which we can probably, that's why the angel, sometimes I spend a lot of time before I do the investment, I do understand the person. Because we are betting on this person and not, probably the idea changes. What he started with today, what you end up in probably 2-3 years back completely could change. But that person's ability to take these ideas, take the strength forward. So that is the major one that we should probably look at, where we have seen that rejected. Cash in the bank, no, we kind of rejected. A complementary skill, he's a techie. We told him to get a co-founder, otherwise it's very tough. So this is the major one. The third is that this co-founders, right? That's a big nightmare. And in my investment, there are 3 are dead because of co-founder issues, right? So this is where that we try to address that early on. Any team I see with the co-founder, I'll say that you need to be talking to your co-founder more than your wife, right? That communication, right? So this is where that we see a big breakup happen. Not only that level, in the incubation center as well, they will not even have a product. They want to go to court, right? So that's the level. The last 3 months, I have mediated 3 co-founder problems. And they are an incubator at NSRCell, not even a revenue yet. So this is a bigger one. Then the perseverance, right? So Avinash, we still talk about it. When at the screening committee, when he applied for incubation, so he was changing the habits. So he said, I want to make people healthy and all. So one of the member in the screening committee said, okay, give 5 push-ups. He did in the screening committee. So we said, you are gotten, right? So that is a perseverance. Are you part of your venture, right? How much passion you have about your venture? That's what I say that this is my startup. So I said, eat your own dog food. If I don't wear handlooms, I keep telling everywhere, handloom is awesome, I'm wearing an Italian jacket. I look like a hypocrite, right? So how much you are believing in your vision and you need to live it. The people in education sector, they'll say, have this experiential learning, I want to apply to government school. Where is your child studying? In probably DPS, yeah? So if you're not your own child, you're not trusting to put it in the school where you're fixing, how you're going to have your product in faith in it. So that's the last element.
Fantastic. I hope you guys took some notes on that. Yeah, Parag? Sure. So usually when startups come to a VC, they're at a slightly more mature stage. What are your red flags?
So I think, see, family in the team is normally something that we wouldn't do. And there are exceptions we'll make, but is that the best person you could find as a co-founder is the constant question. So that I would say is at least a yellow, if not a red flag. And I think the second thing I hear in pitches often is I don't have competition, which is again something that bothers you, isn't it? I mean, I always go back to the old times. Charles Darwin, one of the theory of evolution, would appear amongst the top 10 important thoughts of the world. There was a guy called Maxwell, a Scottish guy, just like Darwin. I mean, that same island, same small island, who was developing the theory. Darwin almost called it Darwin-Maxwell theory. Even if you look at the Mendeleev's periodic table, again, something that we learned, and something as basic as that, there were 6 Mendeleev's table in that time, pre-internet. I'm talking about 150 years pre-internet. So if there were 6 guys working on a problem, how am I to believe you that there's nobody else believing? So please do research. Even if you don't find anybody who's bang on competition, find somebody who's doing a substitute, who's doing something analogous. But that answer is jarring. So those are the 2 things I would say.
Got that. Coming to the entrepreneurs right now, could you talk about, I'll start with you, Sunil. You know, how do you go about negotiating a term sheet or an offer for investment?
Yeah, I think negotiation as a skill is extremely important for any entrepreneur. And I would say that for anybody else also who is dealing with regular day-to-day work also. And why I would say that? Because there are situations where you need to remove the wheat from the chaff, right? And you need to understand what somebody else is talking, and then emotional quotient into those things, cultural questions into those things, and obviously money-related things. And then, see, when you deal with people, even when you are hiring, and that time also you need to negotiate. You need to talk about your venture, and you need to negotiate about the terms and condition of the person who is planning to join your team. The second thing is when you work with investors similarly, there are many cases, especially at a little later stage, many cases where offers are being made, then counter offers are being made, and who start that offer, who start that valuation. So at early stage ventures, it's not about math, right? It's more to do with other things, in the sense, the story which you are painting, the market size you are talking about, the team capability which you are showing, and how much confidence somebody else is actually showing in your venture. So the combination of these things, include math, will determine the valuation, because say sometimes we feel that nobody can give more than this valuation. So we say, okay, the cake size is this much only, right? And we can extract this much from this cake. But then the person who is sitting on the other side, he might have some information which makes this cake much larger, and he is willing to give you a bigger piece of that cake, right? So you have to be, so this negotiation at different level, at psychological level, at numbers level, at cultural level, and every level you have to understand things behind those. And so I would say that it's an extremely important thing as an entrepreneur, not just for investment, but also for sales related things, and when you're dealing with other humans.
Avinash?
Generally, my experience has been that when someone is willing to put money, they believe, they at least have some level of belief and trust in what you're doing. So the question of negotiation largely turns into how do we make sure that all the parties involved are getting what, or are able to maximize their outcomes. And it's a lot about trust and belief in the mission and the vision of the company, the investors who are coming in. If they believe in what you're doing and you are passionate about what you're doing, then 5%, 4% here and there doesn't really make a difference. For both my raises, I had a very simple formula to guide me, and I'll let that be known to everyone here. The valuation, at least for startups, is a mythical concept. You can make any valuation you want. What helped me to determine the valuation of both the companies for which I raised and then sold was a simple formula, which is your valuation of the company is the amount of money that you want to raise divided by 100 into the amount of equity you are willing to give. So if I want to raise 100, let's say $1 million, I am willing to give 33% equity, then $1 million into 33 divided by 100. Sorry, million into 100 divided by 33 will make the valuation of the company 3 million. And that's pretty much it. And then you can use Excel sheets to justify that. So the question for the investor then is, what is the valuation at which they are willing to put in, which would be the money which they are putting into the equity which they want divided by 100. That would determine their valuation. And then you work your way around just to make sure that both the parties are getting what they really want. I have never had, at least with investors, for the first company, Zuzupi, we had 3 term sheets on the table, and we we never really had conversations around valuation, to be very honest. The conversations were largely around, and this would be true for early stage startups, would largely be around the direction of the company, what do you want to achieve over the next few years, how do you want to achieve, and so on. Valuation is largely a mythical question. We were just happy that someone was ready to put in money in our startup at that point of time. So yeah.
I'll give you a couple of more examples. Say initially when we wanted to raise some money, and then around 250K in 2007 timeframe, couple of guys came forward, they gave us a term sheet. And that term sheet had all sorts of things, right? Even a chartered accountant, they will decide which chartered accountant to go into the company and other things. We discussed internally and we rejected that offer, right? The second thing is when another person who little later, he wanted to invest a couple of $1 million and he was giving X million of valuation, right? And then he made that offer. And we thought that it's like ridiculous offer, right? And we never went back to him. And he knew us and we used to meet him and other things. So we never discussed about that thing. And later he told, "Yaar, you guys never came back." And we thought that, okay, similarly that we had so much of trust and other things, why to negotiate? What is there to negotiate? So I think it was more of an inexperience in dealing with these kind of situations. Another thing is when I was talking to Qualcomm, when you negotiate something, so after the deal, I got a feedback from somebody who was part of that negotiation early on. So he gave that the things which you were supposed to negotiate, you were not negotiating, and things which you gave us, so he gave me a feedback where I was supposed to negotiate and could have negotiated better. I did not, and some of the things, they are like standard things in any kind of negotiation. I was actually talking about those things. And that may be because we even hired an external person who was supposed to be one of the best law agency in Bangalore. But I think in technology, product, IP related deals in 2009-10 time frame, I think very few people were aware about those kind of situations. So that may be the case. So they were actually talking about something which were like very standard in any negotiation process. And we were leaving some of the things where we could have negotiated better.
Got that. Now, moving over to the investors. What are your typical ticket sizes and how much equity do you look for?
Yeah, we come in early stage. I have two kind of program. We have one in Madurai. There's an NGO, we say, no English, no PowerPoint. So you pick a local problem, we will support it. So we do around 10 to 50 lakhs, but now the appetite's gone up to 1.5 crores. So where we've set the standard about not more than 20%, right? That is less, below. That is one. Because those traditional areas, there's people have tendency, which is just take money and then put more than 50%, let's control the entrepreneur, right? And do what I say. So that's 20. In the IAN side, we have a policy not to take more than 30 in any deal we do. So we have done anywhere from 5% to 30, depends on the maturity of the company. The investment stage is different, You have an idea, proof of concept, proof of business. All stages we have done investment. But these days, ideas and proof of concept is very, very less, because the incubators have taken that portion of it, right? So today there are plenty of opportunities for people to go and get incubated, get that part out. So mostly in proof of business side is what we are coming at it. And below 30 in IN and below 20 at natively. The other part people need to be very careful is about who you take money from, right? So we have seen cases, and I tell people about the investor-entrepreneur relationship is more than the spouse. You can divorce your spouse, but investors, it's very tough. So it's very important, ensure that who you take money from. And the first question I ask anybody is that do you really need money? right? Because money is just one element of it. I think I was with Amitabh Kant 2 days back. He says 21,000 startup raised with Startup India. Last year, how many got funded? Any idea how many startups got funded? 600 or 700. 21,000 we got. We are an overpopulous country. We have competition for everything, right? One stupid railway job, there's 2 lakh applications, yeah? So this is where we need to look at that. This is an investor market. That means that there are a lot of people out there just give you some crazy deals, terms and all that. And 600, 700 get funded, around 12 billion happened. In that, take up this Flipkarts and Paytm, all these guys, you take out what went into real is very, very, very small amount. So that shows that we are an investor market. I've seen cases even in our incubator, people just giving money for 45% for 50 lakhs, right? And people are desperate taking that as well. So you need to really understand that who you take money from. The next is about if you give too much early on, then when you are doing very successful only, they will have a party, not you. At the same time, you give very too less, then you need to really understand, do you want to have a 10% of $1 billion company or a 100% of a 10 crore company? So depends on what you want to do. So that's a very, very balanced thing that you need to go look at. As Avinash mentioned, there is no rule about valuation at the early thing. It's mostly around the Excel sheet, right? You and I playing an astrologer predicting your future. You change one number in Excel, you'll say this is my number. I'll change one, I'll say this is not, right? So we need to agree between what that thing. So that's why we have a very baseline. We want to ensure that after our round, the entrepreneur feel like getting up morning and go to work, right? He should feel like his own company. If taken too much of it, then that is one. The last is about, I want to give 101 equity investment. Many raised the hand about saying aspiring entrepreneurs, right? How many raised equity funding in this? How many of you raised equity fund? Okay, good. So quick 101 on fundraising. Because the moment you put the word fundraising, our auditorium is full, right? People think that money is the major one, and I see some college students now, sir, I have an idea, where can I get funding, right? So this is what most is happening. Let me give a quick on what is equity investment. So you want 10 lakhs, right? I give you 10 lakhs and I took 10% of your company. So what I've done? What have I done? Huh? What is the valuation? 1 crore. So how will I make money? I'm an investor, right? How will I make money? How? How it goes up? Huh? So you do very well, you are innovative, so you want 1 crore. Somebody gave you 1 crore and value at 5 crore. What happened to my money? 5 times. Huh? What happened? I lost? Not yet, yeah? Okay. So, it went up in 5 times in paper. Okay, so the guy who put 1 crore, how is going to make money? Next. Huh? So you're doing awesome, fantastic. Somebody give you 5 crore, value at 25, so my money went up 25 times. He could offer to buy my stock, right? If not, what happened? The person who put 5 crore, how he will make money? Next. So the final is about the IPO, right? Rarely we have an IPO in this country. So what we call is we are just waiting for the next person. Next person, the final fool is the common man. Yeah? So your mom's mutual fund, all going there, right? So this is where, what is the problem in this model? Huh? It's all in paper, what else? Huh? Speculation. You're going to run out of? This common fool is there, no? People are there. What else? Cascading, what else? So it's about scale. If you do not scale, I lose my money. So there is a pressure on scale. So are you ready to build a scalable business? Because if you don't scale, if you're not innovative, the next round is not going to happen. When that does not happen, I get jittery. I'm going to push you hard. I want exit. So you'll do all kind of crazy things, right? So Voyo is going to Japan, or Uber is starting Idlis, right? So because there is a pressure on scale, so you ended up doing too many things. So you need to realize that you really need money, because if your model is not scalable, it's not that innovative, that you're not ability to raise next level funding is tough, so you're going to get funding. And it's an investor market, right? In the US, there's one startup, there are 150 angels. In India, the other way around. 150 startup, there's one angel. Yeah? So that means that you will attend this course and probably build a slide that top 10 things investors look for. There's a guy who can make a deck as well, right? Today there is how much money you're raising. Based on that, people are there to make you deck. So many of our investment pitches, we tried to ask the question, the guy could not even go to the second slide. Because we're trying to see that how much he remembers. If he says that my data is in the 10th slide, he's gone. Somebody else prepared the deck, the numbers are not in his deck, in his head. So this is the reality about equity investing. Now, do you really want money? So then you need to understand what is behind it. Scalable models, whether you have it or not. If not, you're out of this 21,000 startups competing for the money, where only 600, 700 get funded.
Fantastic. Yeah, some pearls of wisdom there. And one thing which got hinted at but might not have landed is that if you're raising investor money, equity capital, you will have to eventually sell your business because IPOs aren't happening as much in the country. Okay, so if you really like the idea of, hey, I want to do this company for the rest of my life, going the venture capital route might not be for you. All right, Parag, your inputs on ticket size and how much equity to give at different stages.
So I'll talk about where we sit, which is pre-Series A, Series A. So 5 to 15 crore investment from our side, and anywhere between 15 to 25% stake would be typical. We do make exceptions. Our business is about exceptions, but that is one thing. One thing I would say about our valuation at early stages, everybody talked about it being an art and not a science, but I would like to share this perspective with you. Some people get stuck on this pre-money number, okay? I think always look at it as a percentage stake. And he made a point, Avinash made a point about 4-5% doesn't matter. So look at it that way. Let's take an example. $1 million, 10% versus 20%. The pre-money valuation in the 10% case works out to be, if you do the mathematics, $9 million. And this one in the other case looks like $4 million. 4 to 9, everybody will keep on fighting that why not? My friend, colleague, etc. has gotten $8 million. Why wouldn't you give me $9 million? So that equation. But look at it from the investor's side. His chances of making a success are doubling because 10 to 20%. Yours, on the other hand, are coming down from 90% to 80%. If you don't make money at 80%, you will not make money at 90%. So do not get fixated at the early stages about these pre-money valuations. They are just, don't make it a test of your manhood. That's the wrong place to go. Okay, so imbibe this lesson. You need to get the deal done. Don't get stuck on those pre-money kind of things. Okay. Thank you.
Great. I'll this time again reverse, throw it back at you, Parag. What are some key metrics that you would look at before writing your check?
Okay. So
any thumb rules also, if you have. Sorry.
Okay. So, see, we as I said, pre-Series A, Series A investors, we like to see some revenue. It doesn't have to be a whole lot, anywhere between 2 to 15 lakhs. Somebody is paying for that thing. It's not just a product that has been developed. We are talking about companies which are 15 to 30 months old. So we are looking for some revenue. And you are looking for growth, essentially somewhere between 10 and 15% growth on a month-on-month basis, because at that base, you should be growing that fast. Otherwise, what's in it for this thing? In SaaS kind of models, some other metrics come in, like let us say churn, retention, etc., etc. So metrics are driven by the underlying business, but I would say those would be the two key things that we would be looking at when we get in.
Sure. Growth is of paramount importance, what do you say? And probably a 15% growth month on month will make you very suitable for getting interest from institutional investors. Naga? Metrics.
So I told you, we do proof of concept idea, proof of concept, or proof of business, right? I mentioned that these days the proof of idea and proof of concept, most of it done by the incubator levels, right? We hardly do idea kind of investment these days. Proof of business. So proof of business in our 50 lakhs to 10 crore areas, we are looking at maybe 1 lakh a month, right? That's, if you want, depends, right? If you want more money, then more revenue, right? If you have 20 lakhs, then you can go ask for 4-5 crores. And in our native lead model, people just walk in with an idea. So we just look at, that's why I spend time on the entrepreneur ability, what I look for. That's what we look at in early stage. And maybe the space that what we are in, but idea could change. But the entrepreneur is the number one, and is it, the idea is scalable or not? Yeah.
Sure. Sure, fantastic. Last question, we will go to you, Avinash. Tell us how exits look like, what happens. You know, eventually everybody gets to make their money. You as an entrepreneur get to make good money. Can you paint us a picture of what an exit looks like?
Okay. So one thing which Naga said, I would also want to categorically let you know is that the moment you raise money, you are going to sell your company. So that is there for sure. So you come in with that intent. Obviously, you're not always thinking about when do I sell and make money, but that's going to happen. Obviously, making money and it gives you a lot of financial freedom to do what you want to do. But at least with Zuzubi and with Aware, I learned in the process, but with Zuzubi, it was very difficult. I started Zuzubi right after I quit my job at Bosch, and it was very close to me. For the first year and a half, we never took a salary. We struggled a lot before we raised investment or before we came to IIM for incubation, and then eventually when it got sold, all of a sudden the next day, I just couldn't wake up. I couldn't get myself to office. The company was still there, the customers were still there, my team was still there. It was just that I no longer owned it. And so that was a very, it's difficult. Obviously, the money involved is an upside, but it's very difficult. Emotionally, it is very draining and taxing.
Wow, I was imagining you'd say something like, hey, this is amazing, money is flowing in, I can do all the things I could never do before, but thank you for, sharing in that perspective. Yeah, but that's typically how it is with most founders who end up, parting off with their company at that stage. So even these exit negotiations are extremely draining and taxing on
Actually, when we were doing the exit negotiations, I was only thinking about the money that I'm going to make. It was only when the signing was done that the next day I realized that I actually no longer own the company. And it was very difficult for me. I still had to stay there to make sure that the customers, the team and everything is transitioned.
Sure.
But till signing of the contract for the exit, for the purchase, acquisition, I was still all gung-ho about the money that I'm going to get in my bank. Right after the signing, I was like, oh shit, what did I do?
Okay, great. But it's great that you shared both these perspectives. Final thoughts on that, Sunil, and then we open it up for Q&A.
Yeah, I think the exit process is a long drawn-out process where both the parties try to put forth their point of view about somebody is purchasing, somebody is selling. So it's a purchase and sell, and there is no defined price for that particular thing, right? So that's the beauty of that thing. In my case, it was more interesting because of cross-border. Second thing was the person who was negotiating from Qualcomm side, he was supposed to come, he was supposed to flew down to India, and then we thought of sitting across the table and doing the negotiation. But what happened is he applied for his visa. He did not get visa from Government of India, from the embassy there in US. The reason was this guy was born in Pakistan. And so the entire negotiation, and then they did not refuse him to give visa. So they kept on telling him that next week, after a few days, after a few weeks and all this thing. And we kept on doing our negotiation, right? And we broke from that negotiation cycle once, because of whatever they were expecting something, we were expecting something. So it was like overall like 6 months process. Everything happened on over phone calls, right? And I remember that the final, and in fact, in the process, in the entire process of the 3-4 years we worked on the product, all our customer we acquired sitting in India. So we did not make any foreign travel, and all of our customers were based out of India. So most of these top semiconductor companies or OEMs or ODMs in China or Taiwan region or Europe or US. So that was another interesting this thing. And so this, when I remember that the process, which I never expected the process would be like this. So this, on Old Airport Road, there is a building where the fire happened, right? So in that building, that 9th floor or somewhere, that the law firm was there. So the Qualcomm appointed that law firm. So you were supposed to go there, sign on a dotted line, and immediately they will do the wire transfer, and then immediately we will do some of the transfer of technology and all those kind of things. So I did not expect that this, I thought that once you sign on dotted line, then you can transfer something and then money can come. But no, it happens simultaneously. Right? So that was like amazing thing for me to experience, that okay, money is coming in, you confirm that okay, money is there in our bank account, and then you press a button, okay, transfer the technology and some other thing. Like it happens in movies, right?
All right, so we've got about 6 minutes for Q&A. I wish I could give you more, but I think Keshav is going to let us stretch a bit. Questions, please. See, if there are no hands, means you're either understanding everything or nobody is understanding anything. I hope it's the former. Yeah.
Hello. Yeah. Here, this side.
There
yeah.
Okay.
Sure. My question is to everyone over here. When we discussed about evaluation of any company when we started up, and you said that there are no particular formats in which we actually do the evaluation of any company, because this party has one evaluation, the other party has another evaluation. But is there any authentic government, a policy maker, somebody who actually can give this to the people so that there is no ambiguity, both for the startups and as well for the investors?
Just got them out here, don't bring them. No, see, this is about market driven, right? So there is no clear formula. As I mentioned, in early stage, when we come in, you have nothing, we have to believe you, all the gyan you're putting, I don't know where you copied from, right? So this Excel sheet, some CA might have given you some numbers and you're playing with that. So it is very, very tough. When it gets later stage, there are benchmarks that Parag will probably talk about, but in my early stage, there is nothing. There is no formula. That is why that bad angel tax happened, right? Because they said they were questioning our valuation. Then they are given the hands of tax officer. Do you want a tax officer or me to do value a company, right? That guy has no clue. And all these 500 companies have been given all that stuff. But they have a different reason. We will talk about that. I will probably not for this time. But I think this is as long as it's market driven, which is fine. But it gets checked. If I give an overvalue, I think next level of person won't come in. So we have seen cases where we have taken too much of equity. The next VC came in, he said, no, you have to give some back to the entrepreneur for me to come in. We have done it. And in this one of my recent one, this person at Series B, and we saw that his percentage went down very low. So all of us given him a bonus of 5%. So that happens, that is what it has to be, a mutual partnership. It is not about you versus we, just start pulling each other one, then everybody try to see that who is the best person. As Parag mentioned that once we have invested in the company, we are partners. You do well, I do well, right? And if I try to squeeze you on every 1%, 2% on that, and if you do very well, the 1% does not matter, right? Because we're all working together, and that's why we are called angel investor, not a money lender, right? So we I dropped my wings today. So this, we work with them to ensure that, after we put the money, all the Rolodex open, customer, investors, we're all working together and to make that company successful, right? So that's what I've become a cheap model for my own company, right? Because we could not afford a Shah Rukh Khan. So wherever I go, I talk about good co-op and then say, hey, this is the handloom part. I'm sure there is somebody's. So this is what about the angel investing part. And that's why I mentioned earlier, don't worry about too much carried away on valuation part. Ensure that where you take money from. And if you are taking the money from the right people, they're with you throughout. Yeah.
Yep. No, Amit, actually, we have only 2 minutes, actually. Yeah.
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 Yep. Hi, this is Rajneesh here. Naga has been kind enough to be a mentor for me for last 3 years. He has given me 6.5 minutes in last 3 years. Thanks for that. I have been a sole founder. My question is, I have been the sole founder. The company has been growing at a certain pace, but it's not profitable enough to sustain, my expenses anymore. So my question has been, should at this stage, after 4 years, should I look for a founder, a co-founder who can, then can help me make my pitch a little bit better when I go to the investors?
Okay. So his question is, should he, when you are investing, will you look for the co-founders or will you invest in?
So I think this is a similar question. Say I am single till 39 years old, and now I am feeling lonely. What should I do? You got the answer, right? So jab jago tabhi savera.
Yeah, we are. Yeah.
Arvind here.
Yep.
Arvind here. This is
last 2 questions. Last question.
Yeah. Arvind here. Of course, funding is the one that kind of initiates the relationship between investors, be it VCs or angels, and the entrepreneur. But once it falls in place, what is it that is there in the offering, of course, in the form of guidance and stuff for all the investees who are coming in, that's first. The second thing is, as an investor, you are looking for multiples to come over the next 5-7 years. That being the case, what are the kind of flags or metrics that you look at to put in your efforts among your portfolio of companies? Because, even after 2, 3, 4 years, many of these companies wouldn't have typical path to profitability being in place. What are the kind of metrics that you will look at to put your effort behind your investee companies as portfolio managers, basically? Just to understand how it will be for these investee companies in the first 2 years.
So the first question, I think Naga answered in some detail in terms of what help people provide, and between a VC and an angel, there isn't that much of a difference. So I won't repeat that. On the second question about metrics, etc., I think the real truth in the venture capital world is it is those 2 companies out of 10 or 3 companies out of 10 at most that make the fund. Okay, that's the unfortunate truth. That's what happens. It's not to say that we don't focus on the rest of the 7 and 8, but that's how fund economics works. Some of them will not make it. Some of them will not get profitable at any point in time. So what are you looking for as a good investor? You're looking for the revenue line and the cost line, the total cost line, to come together. So gross margin being made with a fixed set of costs, and the gross margin is slowly covering the fixed costs. That's a good business, isn't it? As somebody said, I think Avinash said, that ultimately you have to make a profit. So we are looking not for profit today, but we are looking at those 2 lines converging at a point in time, and the IPO happens when beyond the point of convergence, isn't it? So some people who have higher IP might get bought even before those 2 lines converge, but a business buyout will only happen, let's say an Indian traditional business buying out a technology company, will only happen when those lines converge. So that's essentially what we look for, those lines converging. Obviously, not converging 50 years from now, so there has to be growth, etc., etc. But that's the essential thing.
All right, wonderful. So we'll have to call it a day over here. We can't take any more questions, but please catch the people that you have questions for during the break. To summarize, there have been some fantastic highlights over here in the session. We've covered belief in your product. We've covered team, A-team, complementary skills, product, building the right product, satisfying an urgent need, which has a lot to do with timing as well. Traction, 15% month-over-month growth. Market, big, fast, winner takes all markets. Barrier to entry, briefly touched upon by Parag. What's your competitive advantage? What's long-term sustainable? And probably these 5 things, if you have them well and sorted, well, you are a fundable startup. Thank you very much, gentlemen, for the time and for sharing your experiences.
Okay. Yeah, guys, Amit, special thanks to you for the wonderful moderation. I think this is one of the best panel I have seen. Thank you very much. A token of appreciation for all of you.
Thank you. It's a pleasure.
Before we wrap this, actually, so next what we have is a open source for startups. Okay, if you're using the open source, how effectively you can use open source, what are the licenses you have to follow, in case you're building a product on the open source. Hey, can you just hold on just one minute? It's over, just 1 minute. Okay, so that's on February 7th. Okay, last but not the least, I would like to give you a big standing rounding applause. Big round of standing applause to all the panelists. Okay, those of you who have actually looking for a mentoring or looking for incubation or any kind of things, please write it to the ideas@nsrcell.org. You have any form of query regarding the entrepreneurship or the startup or anything related to the incubation, please write it to the nsrcell.org. Okay, thank you very much. Have a wonderful and great weekend. Thank you.